Hi guys, good morning. Let's get started in like a couple of minutes. Let's see if anyone else is joining in.
Yeah, hi guys. Hope you all can hear me. And yeah, sorry about the what do you call the delay because I had a small issue with the connectivity as well. Yes, and also I had to push the class a little, like 1 hour um, later. So sorry about that because I had something to attend to as well. Anyways, great to meet you guys. So first of all, let me just give you a quick introduction about myself, and then, of course, what I usually do is on my usually during my first classes, I always ask my students to just give a quick introduction about yourselves because the main reason for this is I just want to just get an idea about how you guys are. The main purpose of doing this, I just want to see like from what background a lot of people are trying to do CFA and just to get an understanding about just maybe your name and where you work and why did you choose CFA. So there's so many other advanced call in a sense, like where you can basically look at other scopes. Why do you choose like something like CFA to advance in your career? So just a quick introduction about myself first. Let me share my slide as well. Okay, hope you can see my screen. Right. So basically, guys, I'm Richardson Moraes, as you guys might know already. So of course, I'm a CFA charter holder, and in terms of my qualifications, I have done started with AAT, and then I've done ACCA and a BS in Applied Accounting, as well as I'm a CFA charter holder. And in terms of my work, of course, I work at Userbase. So I work as an associate director there. So I what we do basically there is we cover emerging tech research. So I specifically work in this, under user base, like this segment called Speeder Edge, where we cover emerging technologies, like in-depth research on emerging technologies. So for example, like our industries like generative AI, travel technology, or maybe like something like satellite management and things like that, sort of like upcoming industries. And yeah, so I've been previously working with a lot of, companies, a lot of big companies globally in terms of providing them with investment research, equity analysis, including management consultancy as well. Right. So that's basically about me. And of course, for CFA, I teach derivatives. I used to teach corporate finance as well, but for the moment, I'm only sticking to derivatives. And currently, I am overseas. Just recently moved overseas, but still, I'll be continuing to do classes online for derivatives. Right. Yes. So shall we do a quick round, guys? Like I said, just your name, where you're working, and why did you choose, you know, CFA in general? Like not obviously, like it doesn't have to be anything specific to any subject, anything like that, because of course you don't have a choice anyway. You have to do all the subjects in CFA. So just to get an understanding about why CFA, that's what I'm more interested in, to be honest. And of course, along with your name and where you work. So shall we just start? I think I'll just go with the order that I see on my chat. I think it's Evelyn John.
Hi, sir. Good
Yeah.
morning. I hope
Hi.
you can hear me.
Yes, can. Yeah.
Hi, so I'm Evelyn John. I work for
Mm,
First Capital Equities as a senior investment advisor. And
great.
the reason for choosing CFA is I thought it'll help me out in terms of managing my clients' portfolios, as well
Mm,
as down the line, I'm kind of looking for opportunities in fund management or M&A
mm.
as well. So that's the reason as to why I chose CFA.
Great,
Thank you.
great. Yeah, thank you so much. Yeah, perfect. So yeah, so and also guys, sorry, sometimes when I'm calling out your name, I might misspell it. So of course, when you tell me your name, I'll know it. So I think I was okay with Evelyn. I guess I got your name right when I told it. Okay, next is Harsha. Yeah, sometimes guys, I understand you might have a problem with your microphone that you're not able to speak, or you're in an environment where you can't speak. Then you guys can put on the chat. That's fine. But those who can, it'll be great if you can speak, so that it's a good introduction. You also get to know who the others are, who's studying with you as it's all online classes, right? Harsha, I think if you have mic issue, please put on the chat. Hasini Samarasekara.
Uh, Hi all. Hi sir.
Hi.
I am Hasini Samarasekara. I am working at Unilever Sri Lanka as assistant manager in business analytics. Previously, I worked at Colombo Stock Exchange, so it made me identify the essentials of learning financial mathematics and financial industry. So I chose CFA because of that. Thank you.
Excellent, excellent. Great. So next, I think I missed Dinesh Manchanaik. Yeah, Dinesh, right? Yeah. Just saw that you had logged in again. Dinesh, yeah, just to give, I don't know if you're there when I told this, but just your name and where you work and why did you choose CFA? And of course, if you're in a situation where you can't speak, you can just put on the chat. Dinesh, are you there? Okay. I assume they're not in a position to speak. Nirosha or Nirosha? Yeah.
Okay, sir. Thank you, sir.
Hi. Yes.
I'm Nirosha Vidana. I'm working at People's Bank as a deputy manager. I chose this CFA exam because I want to improve my career path. I'm having a legal background also. I'm an attorney at law. While having
Great.
that qualification, if I get this qualification, then I can give good financial solutions to my customers. That's why I chose this.
Definitely, definitely. That's great, actually. That's really great to see coming from diverse backgrounds. Yes, definitely. I think that's a good call because trust me, I also have friends. When I was doing CFA, I used to have friends who also were engineers. And what they said was, yeah, like, just to advance and have that like the diverse background, he also felt like doing it. So that's really great. Yeah. Good decision. And next I see Ochita. Ochita. I don't know if I'm pronouncing it right. Ochita.
Hi everyone, I'm
Ochita.
Ochita.
Okay, fine. Ochita. Okay, sorry. Yeah. Go
Yeah,
on, go on. Yeah.
so I work at Lance as an asset management analyst.
Mm,
I have a background in data science, so I
great.
just dropped my job is my first introduction to finance, and I just want to further
Mm,
my knowledge on finance with CFA
great.
and like help, I guess, broaden my knowledge on portfolio management and all of the good stuff that CFA provides as well.
Definitely, definitely. Yeah, yeah, yeah. Excellent. Next, I think Ranil Pereira. Mm.
Yeah, hi sir.
Hi.
Yeah, I'm Daniel Pereira. I
Okay.
work for Sampath Bank PLC as a senior executive.
Mm,
I chose CFA basically to enhance my industry knowledge and for career advancement.
okay. Excellent. Excellent. Yeah. Any connection with Ranil Vikramasinghe?
No, none.
Just kidding, just kidding. Cool, cool, cool. Anyways, great guys. Thanks a lot for all your introductions, and I think it was very good to see most of you coming from a lot of different backgrounds, like some into banking, some into like bit of investment advisory side, and some coming from the legal side and data science. That's great to see. And of course, like as you guys are aware, definitely CFA will offer you scopes on various areas. So I think since you guys are just at the beginning of it, you will start seeing it as we move along. Okay. So what I'll do now is initially I'll just take you through what the syllabus looks like for derivatives. I'll just give you a small briefing on like the sort of the syllabus areas that we are looking at. And then after that, right away, we will start with some of the chapters today. And generally, how I approach when it comes to lectures for CFA is generally whenever I, of course, couple a few chapters together, because sometimes one chapter for one let's say one set of slide could be too less. So I feel it's always better to couple it up. And then what I do is once we're done with that chapter, I will give you a set of practice questions also. So which in class itself, right away, you guys will be able to sort of, um, I mean, you can quickly do it in class itself, and then we will be discussing it in class as well. So I always feel like with CFA guys, to be honest, especially for level one, it's a lot of practice. So it's good at the beginning itself when we learn it. It's good to practice. And my advice for you guys also is for level one, you need to do a lot of practice, like as much as I mean as much as you can do in terms of questions. That's what will definitely give you a pass in the exam. Okay. So just give you a quick idea about what we are looking at in terms of the syllabus. Yeah, and I think Harsha he has messaged. Okay, let me just read it out. So I think his mic is not working. He's working as MIS planning at Ceylon group, I guess, C-line group. Okay. I do have accounting background. Now I want to do like corporate finance industry. That's why I started CFA. Very good. Excellent. Yeah. Don't worry about that accounting background doing CFA. To be honest, like I was someone from ACC and then went into CFA, so no issue on that. And of course, like you don't necessarily, to be honest, like need to have any in-depth industry experience for you to learn CFA. If you, of course, have knowledge on corporate finance and valuation and things like that, then certain things might be a little easier for you. But otherwise, don't worry about it. Because of course you're aware that even though you're from finance and accounting background, you still have economics and maths, which is out of your scope. So I know people who have done maths for their degree and they have done CFA. So don't worry too much about how the subjects go, whatever it is. Once you keep learning, it's a matter of getting used to it. Okay. Perfect. So let's just quickly show you a bit on the syllabus side of it. Just a minute. Yeah, hope you guys can see my screen. So in terms of syllabus, right? So to be honest, like it used to be just 3 chapters. When I say used to be, like 2 years back, I guess, yeah, about 2 years before, it used to be just 3 chapters. But now it's the same, pretty much the same, but they're broken down into several chapters, right? So that's why I started like coupling up in terms of the slides, because like it's just a very small chapter sometimes. So there is no point having a separate chapter for that. So just to give you a quick, I'll just give you a quick summary of what we look at. And anyways, when we are doing the chapters, I also include like another summary there. So you can, know exactly within those 2 chapters what we look at. But just broadly to let you know. So initially derivative instrument and derivative market features. So before you do anything, we need to understand, like what derivatives are. And in terms of its features, in terms of, when it comes to like what are the difference between, like what does exchange traded mean, what does over the counter mean, what are the different types of derivatives we're looking at, right? So we look at various types like forwards, futures, right, options. And of course when it comes to CFA level 1, our focus is on stock derivatives. Okay, like we are not going to focus on anything else for level 1. Of course with level 2 and 3 you will see a little bit of more focus into interest rates and I think currency is not really, but interest rates, there is some that comes in as well. But for level 1, of course, it's all about stock derivatives that we're looking at. Forward commitment and contingent claim features and instruments. So basically, here we are looking at all about forwards, right? And including contingent claims. I'll explain you on what that means. Doesn't make sense for me to explain now. But basically, it's about where certain instruments you have a choice, where certain you don't have a choice. So that's what we are looking at under this chapter. Derivative benefits, risks, issuer, and investor users. So then we will also focus on what are the benefits of using derivatives. So primarily, if you see, we all say that, okay, we use a derivative to manage risk, but sometimes we also can try to make profits with that, which is called a concept of arbitraging. So all that we will learn under that. And again, a little deep on that is arbitrage, replication, and the cost of carry in pricing derivatives. So in terms of when we are pricing a derivative, when we have these conditions as arbitrage and cost of carry and so on, how do we account for it? And then we move into pricing and valuation. Okay, so as you can see, pricing and valuation, we are going to break it down by pricing and valuing a forward contract, pricing and valuing a futures contract, pricing and valuing interest rates and other swaps, pricing and valuation of options. So these are basically the 4 types of derivatives that we'll be looking at as well. That is, we'll be looking at forward contracts, we look at futures, we look at interest rates and other swaps. Okay. So basically, when we say interest rates, that's connected with the swap part of it. And finally, pricing and valuation of options. And then finally, you look at this option replication using put call parity. So we learned this concept called put call parity. And where we see, okay, let's say you don't have the capacity or rather options are not available for you. So in that case, how do we deal with that situation? Like, do we have any other synthetic scenarios where instead of actually having like an option where we can do a synthetic option, meaning like, where we actually don't have it, but then we can do some other instruments by using some other combination of instruments, we can replicate that particular impact. Okay. And valuing a derivative using a 1-period binomial model. So that's another thing that we look at. How do we value options? So there are so many ways to value options. So I think some of you guys I'm not too sure if any of you guys are from ACCA background, but if you are, or probably if you have done a degree in finance, you would have learned this concept of BSOP, Black Scholes Option Pricing Model. We don't look at BSOP here, but another method that we use is called the one period model. BSOP is actually coming in level 2. But here we look at one period binomial model, a very simple way in which we can value an option. Okay, so that's it in terms of the syllabus. So like I said, I'll be coupling it up. So totally we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 in total. But like I said, I'll be coupling it up. And today my focus is going to be especially on these 2 chapters, 1 and 2. And then of course we have 3 classes. So I'm planning it out in a way that I'll be breaking it for the other classes along the other chapters as well. Any questions, guys? And of course, in my class, I always, advise if you have any questions, you don't have to wait till the last moment. You can always put it on the chat. And of course, what I do is every time when I teach you guys maybe 2 or 3 slides, I will give you maybe like a minute or 2 for you all to just quickly skim through and let me know if you have any questions. So that time it's easier for you guys, because otherwise, when I just keep on going, you won't have a break for you to just look back and see whether you actually understood, right? So because of that, I feel like it's better that I give you some time, maybe like 2 minutes or 3 minutes, depending on how many slides I have covered. And then from those slides, you can ask me any questions you have. And then we'll move on to the next. Okay. Right. So any questions before we actually can start with the chapter right away? Any questions? Anything you want to check in terms of the syllabus, like, any other general questions on derivatives? And of course, I think another thing I forgot to mention is derivatives is not a very big portion in your exam. It's about 5 to 7%. But that said, you can't fail this by getting a too low of a mark and still pass the exam. I mean, not that it's not impossible, but it's a bit risky. So definitely not just derivatives, any subject in CFA, you've got to make sure that you get like a decently good mark for you to get through, because you know how the marking works. To be honest, like no one knows how they allocate it, because the way they put the Z score, I mean, in a sense, it's called like it's done like a sort of a bell curve actually. So they have some scenario which they do that. It's something that the Z score that you have fail levels. So no one knows how it works. So that's why you can never, imagine. Sometimes, to be honest, even 70% could be the pass mark. Sometimes it could be 60%. So it depends on the paper and definitely on the examiner. So make sure that you don't skip anything when you're studying for CFA. You don't have a choice, no matter what. Okay. So make sure that you study everything. Yeah. Any questions? And yeah, one more thing, guys. Whenever I ask if you have any questions or if everything is clear, it'll be great if you all can just put a thumbs up or an okay, because I have no way of seeing you guys. So the only way in which I know that you guys have understood it is if you say okay or a thumbs up. Otherwise, until that, I have no clue. I can take silence as a yes, but I generally appreciate if you can, just put a thumbs up or an okay. Yes, everything is clear. Otherwise, if any questions, you can mention. Okay, so I see many people putting a thumbs up and okay. So I assume that it's fine then. Let's move on. Okay, so let me share my screen once again. Okay, can you guys see my screen? And also, guys, feel free to let me know if in case, there is some connection drop and you guys can't hear me, you can't see my screen. Please don't be silent, because that time I have no clue. Sometimes I might just keep on going like that, and then later, you guys might, if you don't tell me, I will not know. So just keep in mind that, whenever you have face any connectivity issues or anything from, when I'm speaking to you can't hear me clearly, please let me know. Right. So, like I said, we are going to do today. We are going to focus on these 2 chapters. Okay, so that is one is going to be derivative instruments and derivative market features, right? Reading 66. So, if just to let you all know, I mean, I don't know if there is anyone in this class who have done level 1 already and they are doing it for the second time, or like they're trying it again. If you guys are anyway using like maybe older, let's say study text or anything like that. If it was last year's study text, then nothing much to worry about, because there is no major change. Like I said, already the chapters were broken, but they have just changed the numbers because some other chapters have changed in other subjects. So the chapter numbers would have changed. Sorry, the chapter numbers would have changed. So apart from that, in terms of syllabus, there is no change. Okay. And then we'll focus on forward commitment and contingent claim features and instruments. All right. So key learning outcomes. Here, define a derivative and distinguish between exchange traded and over-the-counter derivatives. Now, this is very important to understand. Okay, what is exchange traded? What type of derivatives come under that? And what type of derivatives come under over-the-counter? Contrast forward commitments with contingent claims. So next is, we are going to see the difference between a forward commitment and a contingent claim. What does that mean? Okay. Define forward contracts, futures contracts, options, swaps, and credit derivatives, and compare the basic characteristics. So now today itself, I'll be introducing you to all the different kinds of derivative instruments. Okay, but of course, we won't go into a lot of detail as to pricing and valuation and so on, but we'll focus more on like a general idea behind it, right? So forwards, futures, options, swaps, and credit derivatives also like overall to look at it and compare their basic characteristics. Okay, that's the word basic. Determine the value at expiration and profit from a long or short position in a call or put option. So we look at this concept of, what does value at expiration mean and how do we find that value? And then we look at the profit from a long or short position in a call or put. Okay. Right. What is a derivative? Okay. So I think some of you guys might already have an idea about this, but those who don't have an idea about it, don't worry. I'm going to start with the basics itself to teach you what a derivative means. The simple idea is it is a financial instrument that derives its performance from the performance of an underlying asset. Now, a derivative, guys, it's not an asset on its own. Okay, is that clear? A derivative is not an asset on its own. Like, for example, okay, let's take a particular stock. Okay, let's take John Keel stock, right? It is an asset on its own. It has a price. Okay, it is not based on, I mean, it's independent. Okay, it doesn't have to be based on anything. Of course, it's an independent price and it is, all about how JKH performs. It's all about their value, right? But a derivative is always attached to an instrument. In a sense, its performance is derived from the performance of an underlying asset. So you can have a derivative on the JKH stock, but JKH stock is not a derivative. Get my point? So derivative should always be based on an underlying. It's not on its own. It's always based on its underlying. Does it make sense? So, for example, like I said, okay, so before we go into anything, I'll just give you just a quick example to understand what a derivative means. Let's say today, okay, the price of a JK, and also, sorry, bear with me, my handwriting is not the best, but I'll try to keep it as clear as possible. Okay, so let's say today the price of JKH, okay, share is, let's say, about 25. Okay, just an example, right? Today's price is about 25, right? And let's say, okay, you want to buy JKH not today, but you want to buy it maybe in 3 months' time, right? So today's price is 25, no? But you want to buy in 3 months' time. But in 3 months' time, like I don't know what the share price will be in 3 months' time, right? I know, like I can, of course, use my analysis, use my valuation knowledge, and I can sort of predict something. But is that the accurate rate? It's not definitely the accurate rate, right? Because it's what we are forecasting. So I don't know what the rate is in 3 months' time. Okay. So when you want to buy something in the future, let me ask you all something. Okay. Guys, time to time I ask questions like this also. And if you know the answer, definitely I would recommend if you guys can use the mic and answer, that's good. But otherwise, certain questions, of course, I will tell you guys, put on the chat just to get everyone's opinion. Okay, but certain things I might just randomly ask away. You can use the mic. No harm in that. Okay, please feel free to use the mic. Okay, so this answer, I want you guys to put on the chat. Can you tell me if you're going to buy something? Okay, will you want to buy at a lower rate or will you want to buy at a higher rate? A very simple question. Okay, let's say you want to buy something, whether you want to buy at a lower rate or a higher rate. And when I say buy, it's not today because I know today's price, but I'm looking at a price in the future because I'm not going to buy today. I don't have the money today. Imagine I don't have the money today. I'm going to buy in about 3 months' time. So will it be excellent? So obviously we all know we should buy at the lower rate, right? So the problem is now this 25, I don't know in 3 months' time what the price is going to be. I mean, let me just give you 3 scenarios. Okay. So let's say one scenario where the price is from, let's say today's 25, the price has come down to 20. Another scenario where it stays at 25 itself. Another scenario where it has become, let's say, 30. 3 scenarios. Okay. Now, let me just ask you a quick question. So let's say today it's 25. Okay. So let's say in 3 months' time, it is becoming 20. Right. So then what do you think? What I want you all to do is, can you tell me in these 3 scenarios? Again, put on the chat. Can you say 1, 2, and 3? And can you tell me whether you are benefiting, like buying it in 3 months' time at that price or at today's price? Okay, so we can just say today or future. Just use those words. Like future means you're saying this price. You're saying buying at 20 is better. At 25 is better in that way. But if you say today, that means you're saying buying at 25 is better. Okay. Can you just quickly put on the chat saying 1, 2, 3, whether it is today or future? Just use those 2 words. That would do. Like, which is the price that is better for you, where you will benefit. Yeah. And guys, if you can just take like 1, 2, and 3 and just say 1 today or future, 2 today or future, 3 in that way, I'm saying. So it's easier for me to see if you guys, understood that part. Good. So I see some answers. The others also, if you are still, putting it, please do. Very good. So I think, as you all said, of course, at 20, it's good if you can buy at 20. It's beneficial at 20, right? So here, I think, obviously, it's going to be future. When it's 25, very good. I think some of you guys said either, some of you guys said no difference. Yes. So basically, it's okay, whatever you buy. So either is like word I will use as well. 30, of course, definitely today is cheaper. Right. Now, what if I tell you, I'll just start with the very basic one, the forward contract. Okay, where I'll tell you that you are entering. So let's say you are going to buy, and there's another party who's telling you, look, if you buy in 3 months' time, okay, I will give you a price of, let's say, 25 again. No matter whatever happens to the share price, you can buy at 25. So we call it a forward contract. So let's say the forward price is 25. And a forward contract, guys, to be honest, you don't have any cost or anything involved. It's like you are actually entering it with another party. Another party is saying, well, no matter what, I will give you at 25. Okay. So in that case, can you tell me now, just like how we identified for 1, 2, and 3, if it's at 20, what is the price that you will get? Okay, let me first explain that to you. So if it's a forward contract, that means no matter whatever happens in the future, whatever the price in the future is, you will still get the same price. That's what a forward contract means. So this is a classic example of a derivative, a very basic one where what have we done here? I have hedged my risk. I have made sure that no matter whatever happens in the market, I will get 25. So the good thing is when it's 20, it's bad in a way because it's 20 in the market, but I'll be buying for 25 because I agreed saying I'll buy for 25. Okay. But here, when it's 25, it's again either, it doesn't matter. But the thing is, if it's 30, you will benefit by buying at 25. So can you see, no matter whatever happens, in all 3 scenarios, you'll get 25. So this is like the classic example of derivative where, just to tell you that if you are going to buy, or let's say rather enter into derivative, so you're looking at fixing it in the future. Okay. So the ways in which we fix it is different for different instruments, but that is the idea that we should understand. Okay. So now the one more thing which I want to take you all through is, right, I'll just ask you, I'll throw it out as a question itself. Right now, let's say there were 2 parties, right? So let's say me who is A. So let's say I am A, and there's another party B who agreed on this, right? Or there's another party B who is saying he will sell me this asset for 25, no matter whatever the price is. Okay. what do you think his purpose of entering into this is? Okay, now your purpose is understood because you want to basically you want to make sure that you want to protect against and increase in the price, right? That's the honest thing. That's why the 30 is like the best case scenario for you, right? This is the best case. Why? Because when the price is 30, you know you can buy for 25. So you want to make sure that you don't, let's say you want to make sure that you don't pay a high price in the market. But what about the other party? What do you think? So your basically I would say your expectation is, when I say A's expectation is that the price is going to increase in the future. What is B's expectation? What is B's expectation? Anyone? Can you put on the chat? So, like I said, A's expectation is you don't want the price to increase in the future, right? You are afraid that the price will increase in the future. You're thinking the price will increase. That's why you're entering into forward, right? Because if you think the price is going to decrease, then why would you enter into forward? Then you can just wait and buy at the lower price in the market itself, right? The reason why you want to enter into the forward is because you know that the price is going to increase in the future. Like you are quite certain about it and you think that it is. So why is another person selling you for that price? Like what is his thought? Perfect. So his thought is that the price is going to drop because he knows. Now, let's say, for example, the price, he's thinking the price is going to drop. If the price dropped to 20, see what you did, you still bought for 25. Now, that party benefits because he's going to buy in the market at 20, sell it to you for 25. Because you agree 25. Now, can you see both of them have some, otherwise, why would that guy is a useless guy, right? Why would he just enter into something when you are getting the benefit? I mean, why would anyone do anything like that, right? So that's the idea behind this. So so this is why we say a derivative is based on another underlying. Okay, it is not something that is on its own. So now I'll teach you a little more further on this concept of long and short. The buyer who purchases the derivatives, which is meaning the buyer is in this case A, who is buying the derivative, okay, is referred to as long. So we call them as long. So whenever you're taking a long position means, guys, you're going to buy in the future. So be careful with those words. Sometimes in the exams, they use those words long and short. So long or the holder because he owns or holds the derivative and holds a long position. So he is the holder. In this case, A is the holder of the derivative. He is holding it. Okay. And the seller is referred to as the short because he sells the derivative and holds a short position. So of course, since you are the long, the seller will be called as the short. Okay, because he sells the derivative. Okay, is that clear? Like any questions on that? Is everything clear on that side? Like, see, I will teach you on the other derivatives I given forward. I'll explain again, but I just wanted to give an idea. So do you understand what a derivative means? So, like I said, it's not based on, it's based on the underlying. It's not independent. It's not on its own. It has to always be based on something. Any questions, guys? Any questions? Yeah, if not, thumbs up on it. Okay, guys, please, so that I know that you guys have understood it. Okay, good. Great. So next we look at exchange traded versus over the counter. Now, if you look at derivatives, right, like I said, we have forwards, we have futures, we have swaps and so on, right? So we need to classify them under two broad categories. One is called exchange traded, the other one is over the counter. It's very easy to understand also what each of them mean. Exchange traded derivatives are standardized and they are backed by a clearinghouse. Example, futures and some options. Now, when we say exchange traded, these derivatives are standardized. Okay, they are all, set at a particular standard, a standard size. Now, sometimes the biggest problem that happens here is if you have a like let's say you want to customize it, you can't. Okay, because the good thing here is it's backed by a clearinghouse. So because it's backed by a clearinghouse, you can just make a note of this. It doesn't have counterparty risk. It's mentioned that. No counterparty risk. Meaning, now let's say sometimes there's always a scenario like this, right? Okay, let's take the first scenario which I told you. Now, I said there's a party who is willing to sell you at 25. Now, let's say the market price is going for 15, right? Then let's say the market price is going for 50. Still, he has to buy in the market at 50 and sell you for 25. So sometimes what happens is there can be defaults because the other party can always say, I don't want to pay, I can't pay. But you can't do that for exchange traded because there is a clearinghouse which is backing it. So that's why we will learn later. There is a small deposit also you have to make when you enter into this futures, for example, one of the exchange derivatives. Like forward is something, futures is something like forwards. I'll explain you later. So what you should understand is that exchange traded means I'll show the classification later. What comes under exchange traded, what comes under what do you call over the counter. But exchange traded basically means that the derivatives are standardized and they are backed by a clearinghouse. Okay. Forwards and swaps are custom instruments and they are created by dealers in a market with no central location. Now, on the other hand, if you take forwards and swaps, these are called over the counter because they are very customizable instruments. Okay. A dealer market with no central location is referred to as an over the counter market. They are largely, so basically speaking, it's a dealer market that we say. In a sense, it's like it consists of dealers, like agents, and they are largely unregulated markets, and each contract is with a counterparty. Now, the problem with this is it's unregulated market. Okay, so which means you have a counterparty risk, which may expose the owner of the derivative to default risk. Some options trade in the over-the-counter market, example, mainly bond options. So normally, if you see some of the options do trade in the over-the-counter market, one of the best example is the bond. Bond market is an example of that. Okay, so anyways, like I will show you guys the different, like what derivatives comes under each type. So what does over the counter you're clear? It's customizable as well as it's with another dealer or an agent. Whereas exchange traded it's all traded. So just like your stocks trade, we have a derivatives exchange where trading happens there. Okay, so just to give you a briefing on that. So remember, exchange traded, you can make a note of this, okay? So under exchange traded, we have the following: futures, all futures, okay? Any future will be exchange traded and some options, okay? But over the counter, say OTC, forwards are always OTC. So all forwards are OTC. Some options are OTC and all swaps are OTC. Does that make sense? Make a note of this, guys. It's always going to be the case. So just make a note of it. So exchange traded, we have futures, all futures, some options, and OTC, we have forwards, and we have some options again, and we have all swaps. Okay, there is a good question. Let me see. Yes, so there are a few questions. Let me answer that. So one of the questions is, are all forwards are OTC? Yes, I think I cleared that now. All forwards are OTC, no matter what. In forwards, long position is for the buyer and short for the seller, which completely different scenarios. How's it just okay? Good question. So we take a forward, right? So if you're a buyer, we say yes, you're going on a long position. If you're a seller, you take the short position. So ideally, if you're buying, then there is someone else who is selling. Same way, if you're selling, someone else is buying. So that's how we enter into a transaction. So if you have a long position, that means that the person who sold you has a short position. That's what it is. That's the idea. Is that clear? Did I answer questions? Or you have any follow-ups to it? Okay. Right. Cool. So any questions on this? Anything else to clear? Right. So let me go a little bit more deep and explain you. Now, see, we have various categories, okay, in the way we which sort of the way we identify it under, we have different sort of clusters. So first side of it is what we saw as the exchange traded and the over the counter. Now we're going to look at what is a forward commitment, what is a contingent claim, and what are the ones that comes under both. So forward commitment is a legally binding promise to perform some action in the future. Now, forward commitment, the word commitment means what? You're committed. Okay, commitment means It's a legally binding promise to perform some action in the future. So if you're committed, that means you are making sure that you will do it no matter what. You don't have a choice. Okay, you have no choice, right? So example, forward contracts, futures contracts, and swaps. So I think I've given the example already over here. So forwards, futures, and swaps. Now, can you see here? Futures are getting clocked along with forward contracts. The reason is because both of them are forward commitments. Okay, does that make sense? So forward contracts and futures contracts can be written on equities, indexes, bonds, foreign currencies, physical assets, or interest rates. There you go. So basically, your forward contracts and futures contracts are written on various instruments. So it could be equity, could be indexes, could be bonds, could be foreign currencies, physical assets, or interest rate. Various, instruments. A contingent claim is a claim to a payoff. This is the interesting one that depends on the occurrence of a particular event. A contingent claim means the classic example I can give you is just take insurance. Okay. Now, every year you pay a premium. Now, let's say you're on a full premium, quite expensive. Every year you pay. But if there is an event, what is the event? You meet with an accident, you will get a claim from them. Okay. That's what you mean by options are contingent claims that depend on the stock price at some future. Sorry, contingent claim is a claim to a payoff that depends on the occurrence of a particular event. So the classic example of a contingent claim is an option. So we learn options later where you have a choice. Like the first example that we saw before, where you have no choice, but no matter whatever the price is, even if it's 20, 25, 30, I have to go to 25. But if I had an option where I can choose, when the price is 20, I would have bought for 20. Why would I go for 25? When it's a 30, yes, makes sense for me to anyway buy at 25. But we can sort of make that choice. That's what we say. Options are contingent claims that depend on the stock price at some future date. So it is a contingent claim that depends on a stock price at some future date. So it depends on what at that moment, what is happening. Okay. Because of the flexibility, these normally come with an upfront payment. So generally, when it comes to this now, obviously, if you have a choice, then definitely with the choice comes what? It's always a cost, right? With the choice, it always comes a cost. So that's the idea over here. So in this case, since we are looking at the choice, we also have a cost attached, which is also called the premium or the upfront payment. Credit derivatives are contingent claims that depend on the credit events such as default or ratings downgrade. So credit derivatives, on the other hand, is where it's basically these are claims that depend on a credit event such as a default or downgrade. So if let's say your company downgrades, or like let's say your credit rating has changed, then this will basically give some claims. That's called contingent claim. So again, that if word should come in. So just make a note of that. Okay. Right. Any questions, guys? Yeah, I'll give it about 2 to 3 minutes. Can you quickly go through what we have learned so far? Because on the basics, guys, I'll be going a little slow, to be honest. I normally do that because just to make sure that you guys get the hang of it. And then after that, we can speed up a bit because by that time, you know the basics well. Because otherwise, if I rush on the basics, then it might be difficult to understand certain concepts later. Okay, can you skim through? Let me know if you have any questions, guys. Anything that you want to clarify? Any questions on that end? Okay. So I did see one question. So let me answer to that. So the question is, I think, on letter of credit. Is letter of credit a credit derivative? Good question. The answer is it is not, because now remember, now credit, when we say the word, a contingent claim, or rather a credit derivative. Now, credit derivative is basically where if there is a default that happens, you will get a payoff. Now, just like in insurance. So remember, contingent claim is like an insurance. I mean, insurance, how does it work? You pay for your insurance premium every year. But does that mean that every year we meet with an accident? No, right? So when you meet with an accident, you get a claim. So just like that for a credit derivative, if you get a ratings downgrade, then there comes a payoff there. Okay. So letter of credit is where basically you're giving a guarantee. So let's say a bank is giving a guarantee saying that this party will pay this party. So which is used by importers just to get that guarantee that they do have funds in their accounts and definitely they will make the payment. Right. So that, and these are two different things. Okay. Right. Let's move on then. Right. Now let me just give you an idea about each and every derivative. A forward contract is an over-the-counter derivative contract. Okay, so that's something that, like I said, all forwards are over the counter, in which two parties agree that one party, the buyer, will purchase an underlying asset from the other party, the seller, at a later date at a fixed price they agree on when the contract is signed. Now, can you see there are so many different words here, very important words, okay? Two parties. Always when it comes to forward contract, there are two parties involved. Like I said, one party is going long, the other party is going short. Agree that one party, the buyer, will purchase an underlying asset from the other party, the seller, at a later date at a fixed price they agree on. Now, to be honest, now how it works is, now when I say the party who is going long, okay, is a party is going to buy, right? Now there's another party who is selling that for you. So that's why we call that as he's taking the other side of the position, okay? So one party who is the buyer will purchase an underlying asset from the other party who is the seller at a later date at a fixed price they agree on. Now, can you see these words? These are like some important words. Let me write it separately. So later date, fixed price. So it's not buying today. If you're buying today, you don't have to enter a derivative. You know what the price in the market is, but you're going to buy in the future. And the price is a fixed price, which they agree today. So that's why if you see the example I showed you, that 25 was the price which is agreed today. Okay. When the contract is signed. It can happen in the future. That's basically looking at when the contract is agreed today. Okay, does that make sense? Okay. So the party to the forward contract who agrees to buy the financial or physical asset as a long forward position, and is called the long. And the party to the forward contract who agrees to sell or deliver the asset as a short forward position is called the short. So the long party, I think this is already explained. So the party who is going to buy the financial or physical asset is having a long forward position. The party to the forward contract who agrees to sell or deliver the asset has a short forward position, and it is called the short. Okay. There is no payment at initiation, and either party can benefit from based on the direction the price move. If you think about it, you don't have to pay anything because both can benefit by this. That's why I told you now your expectation as a buyer, you are expecting the price to increase. The other party is expecting the price to decrease. If the price increases, you will benefit. The price decreases, they will benefit. Simple as that. Okay, so the price increases, you will benefit. The price decreases, they will benefit. So that's how it works. There is no payment. Okay, and forward also, guys, we have two kinds of forwards. I mean, when we say two kinds of forwards, the main purpose is like how it's being settled. A deliverable forward contract is settled by the short delivering the underlying asset to the long. It's like, for example, now let's say you have party A and you have party B. Let me just draw it and show you. So in deliverable, how it works is, so let's say you have party A, you have party B. Now, basically, guys, let's say this is the buyer. Okay. So B will actually deliver the asset. Understood? So B will deliver the asset in a sense. Now it's like basically they might sometimes even buy it from the market at a higher price and give you at a lower price. So basically they are giving it to you. They are basically buying it and giving it to you. So they're giving you the asset itself You just directly pay them that price that you agreed on to get it. That sort of a thing. That's called deliverable. But another popular way in which we use derivatives is a cash settled forward contract. I think the word you would have understood it. Contracts for differences or non-deliverable forwards. We call it NDF is another word. So we have deliverable forwards. We have non-deliverable forwards. One party pays cash to the other when the contract expires based on the difference between the forward price and the market price of the underlying asset. You get the point. So here, one party pays cash to the other when the contract expires based on the difference between the forward price and the market price of the underlying asset. So it's like, now, for example, if you take the previous scenario, now here, okay, let's say A and B. Okay, so let's say A. Okay, so let's take A and B. So A, of course, basically, when you look at it, we have, so let's say A is the buyer, B is the seller. Okay, A is the buyer, B is the seller. Now here the difference is, now let's say, let's take the same example as before. So let's say the price, let's say today's price is 25. Okay, and we can buy, we have an option, sorry, we have a forward contract that says we can buy at 25. Okay, but in the future, let's say the price is 30. Three months, just say 3 months. Right? So what the cash settle means is now in the market, the price is 30 now, but you agreed on 25, right? So the difference, which is 30 minus 25, which is 5, the other party will pay you. Now you go and buy at 30 in the market. Okay, so you buy at 30 and you will receive 5 from the other party. So eventually you bought it for 25. That's what cash settle means. See the difference, right? Now, even in a deliverable forward contract, that party will deliver you the asset itself. If it's an NDF, non-deliverable forward contract, you will buy in the market at the price and then they will settle you whatever you're losing. Now, it could be sometimes other way around where, let's say it's 25 and the price in the market is 20. You'll buy in the market at 20, but you have to pay another 5 to the other party. So eventually you're paying 25. So no matter what, the amount you're paying is still the forward price. But it's just that the way in which it works can be different. One can be a deliverable one is a cash settle. Any questions on that? Any questions on that? Anything to clarify? Okay, let me explain. So there is a one of you guys a message saying like it's a little confusing, but let me explain that again. And there's another question: what kind of assets or securities are normally involved with forward contract? I mean, any kind of securities, like you can have shares, you can have interest rates, you can have currencies. Okay, I think I couldn't tell that part. If you want to make a note of this, so we can have derivatives on various, we call it as underlying assets. Okay, so we can have it derivatives on these assets. So normally the underlying assets, the most popular ones are, it can be on shares, it can be on, I should have told this before. Good that when you guys told me. I mean, good that you asked me that question. Shares, interest rates, it could be on currencies, could be on indexes. It could also be on what do you call oil. You even have like orange futures in your US exchange. You have orange futures, so it could even be like that. Commodities basically, commodities and so on. So any kind of assets basically, like whatever has a price that's trading, it can be based on that. Okay, so let's just explain this again. Now think of it like this. Now you have party A and party B. Okay, A wants to buy something in the future, right? But they are uncertain that they're thinking the price will go up in the future. So they want to make sure that they fix the price today so that they can buy at that price no matter what. So if it's a deliverable forward contract, when that price is fixed, the other party who is willing to give you that price, whatever the price in the market is, he will buy it and he will give it to you for the price that you agreed on. In a sense, there is actual delivery of the asset. But a cash settle forward contract means instead of delivering the asset itself, you go for the market and you get the market rate. Depending on whether you get a bad rate or good rate in the market, you'll get a payoff here. So for example, let's say the market gives you a bad rate, then of course you should, try to get a positive for you. But if it's a good rate, it becomes a negative for you. That's the idea. Is that clear? Is that clear? Any questions on that? Okay. Perfect. Right. Okay. Yeah. And also, guys, yeah, if you want to just make a note of this, just give you about a minute or two. And can you skim through and let me know if any other questions, please, before we move on? Okay. So I also got another two questions. Let me just clarify that first. In cash settled forward contract, the seller will always benefit. Not really, because now it's like this, right? Now let's say it depends on the price. No, now let's say it's cash settled. Okay, now let's imagine the price that you can buy for is, let's say in the future the price is 20. Okay, but your price that you can buy is at 25. So in that case, even though like the market is at 20, you will buy in the market at 20. But because you agreed for 25, you have to still pay 5 to the other party. So the other party is benefiting because the other party can anyway buy it cheaper in the market if he wants to. So he can get 25 from you. He can buy the asset if he wants at 20, if he wants to. You get it. But the other way around, if the price goes to 30, you will buy at 25, but you have to pay 5 for the other party because you agreed that you will give him at the price of 30. So both parties can, who benefits depends. So it's like both can't benefit at the same time. You can make a note of it for forward contracts, both can't make a benefit at the same time. It's either none of them benefit, if it's at the same price basically, or one of them only can benefit. If one benefits, the other one will lose. Okay, there's another question. At 30 scenarios, seller should pay 5. Is that so? Yes, that's right. If it's 30 scenarios, seller will pay 5. The reason is because he agreed saying that he'll give it at 25. In 20 scenario, buyer should pay 5. Yes, because he agreed that he will pay 25. So even though he paid less in the market, he can't still escape with that. He has to still pay the extra 5. Okay, got it. Any questions on that? Okay. Perfect. It's really happy to see you guys asking so many questions. Like it's always good. Whatever questions you have to always get it clarified. Great. Let's look at futures now. Now, futures, guys, to be honest, just to give you a rough understanding, pretty much it is similar to a forward contract. When I say similar to forward contract, it is actually doing the same thing. You're fixing the future, but the way it does it is the difference. Instead of just entering it with another party, here it's exchange traded. So you buy and sell futures, and that's how you hedge your risk. Okay, so let me explain you. A futures contract is a standardized derivative contract created and traded on a futures exchange in which two parties agree that one party, the buyer, will purchase an underlying asset from the other party, the seller, at a later date and at a price agreed on by the two parties when the contract is initiated. So pretty much, if you look at this, it's very similar explanation to what we already saw for forward. Okay, exact same thing. I mean, the key features, if you look at this, the difference here I would say is a standardized derivative contract. Apart from that, two parties agree that one party, the buyer, and will purchase the underlying asset from the other party, the seller, at a later date and the price agreed on by the two parties when the contract is initiated. So there is a daily settlement of gains and losses. And okay, now here, the interesting part is we have a daily settlement of gains and losses. Okay, and a credit guaranteed by the futures exchange through its clearinghouse. Okay, let me first explain you on the credit guarantee part. Now, the good thing is, since we are dealing with futures, okay, unlike unlike what you call forwards, which futures are exchange traded, right? So we said that they trade in an exchange. So because of that, you don't have that counterparty risk. Now, if you take forwards, the biggest problem is now, like I said, let's take cash settle. Now, the other party agreed, he'll give it at 25. Let's say the price in the market is 50. Okay, so if I buy it at 50, I should receive 20 from him. But he's not able to pay me that 20. Okay, maybe he is defaulting, or maybe he's not in a position that he's able to pay. You will then, if they default, then you're not successful there. But the good thing with the futures is you don't have that problem because there is a margin deposit that is requested in general. Okay, so I'll explain that margin bit also later. We'll be coming to that. So because of that, you have a guarantee. So if it's exchange traded, you normally don't have a counterparty risk. Okay, so keep that in mind. I'll write it for you all also. So when it is exchange traded, no counterparty risk. Does that make sense? Okay, so the other thing to understand is that now when it comes to futures, guys, there is a daily settlement of gains and losses. Okay, let me explain you how it works. Now, in futures, like I said, you will buy or sell futures, and that's how you deal with when you're going to hedge in the future. Like, for example, if you buy today, okay, now it's going to be today, right? What you're going to do today, and at the day that you're going to buy or sell, right? So, which is we can call it as the transaction. Okay, so let's say today you're buying futures. Now, don't worry, like when will you buy, when will you sell? I'll explain you guys later. Okay, don't worry about that now because when it comes to pricing, I'll go into more detail there. Because I can't give an example now to show you because it might be a bit difficult to understand already. So I need to show you with the pricing scenario to explain. Okay, but just keep this in mind. If you buy futures today, then you will be settling it, or rather to close it, you will sell. In the same way, if you sell futures today, you will settle it by buying futures in the future. Buying futures in the future. Yeah, you get my point. Okay. So the idea here is that if I'm buying futures today, so it's like the simple idea is I should take the opposite position to sell it. If I'm buying something today, then I'll sell it in the future to close it. You get my point. So I'm basically holding it till that period and then I'm settling it. If I sell today, then I have to buy later. But that's the scenario that you need to look at. Okay. So buy today, sell later, sell today, buy later. Understood? Okay, any questions on that? Anything to clarify? Okay. Now, what we mean by daily settlement is it's like this. Now, when it comes to futures, unlike forward contracts, okay, we are now in a forward contract. What actually happens is, like I said, today you'll enter into a forward contract, but you'll actually wait for like 3 months, and then you see, okay, what's happening in 3 months' time. Like I said, like there were three rates. So in 3 months' time, we will know whether the price has increased or decreased or the same. Then you minus and see and you do a calculation and you check it out. You get what I'm trying to say? So it all matters based on that time. So that's what basically it is about. Okay, is that clear for everyone? So the idea here is that now when it comes to forward, yes, we know in 3 months' time only we check it and we know whether we have to pay or the seller has to pay or what we have to do. Right? But in futures, what we do is daily we calculate whether there is a gain or loss. Okay, for example, now let's say we are at today, right? At the end of the day, Okay. Let's say now the situation is you buy and you sell. No. Now, when you buy at a lower rate, now let's say when you buy and sell futures, like there is a rate. Now, just like a share price, every futures will have a rate. Now, let's say you're buying at, let's imagine when you buy, the rate is 25. When you're selling it, when you're selling at the, because every day you do that. Okay, when you sell it, you will sell it for, let's say, 27. The price at the end of the day became 27. Okay, let's say the futures price was 27. The futures, but remember, it's a separate price from the share price. Okay, it's a separate instrument. No, it's based on that. Now, let's say JKH will you don't have futures in Sri Lanka, but I'm just giving as an example JKH. Okay, so JKH, let's say you are buying it for 25, that futures price. The next day, or rather the end of the day, it has become 27. Now, if you buy something at 25, if you sell something at 27, what is that? A profit, right? So you have a profit. But this is called an unrealized profit. Now, what we do is this profit, now let's say the next day we do this calculation again. Now, what happens is once we keep adjusting like this, at the end of it only, when it becomes, the day when actually we are going to buy or sell, we would have already adjusted for all this. So the exposure is being managed already. It's not like a forward contract where nothing is being done. Suddenly, in like 3 months' time, you have to make a payment or you have to make a payment, whatever it is. But that issue will not be here. You get what I'm trying to say, right? So that is the concept of how a futures work. So daily, this is called the daily, the word that we use, this is called the marking to market. Okay, marking to market, or sometimes we also say the word mark to market. Okay, which means you can say in brackets, daily settlement of profit or loss. Okay, is that clear for everyone? So daily there will be settlement. So I'll explain you further about the guarantee part of it with the margin. Okay, before that, the exchange sets the minimum price fluctuation, the tick size, the daily price move limit, the settlement date, and the trading times for each contract. Now, unlike a forward contract, this is very standardized because it's like an exchange, no? So you can't set like the way you want. Okay, sometimes what happens is the biggest problem is, let's say you want to hedge a particular number, that may not be possible. Then you have to make sure that you get something around that. So there might be some slight over hedging or under hedging. Especially this problem comes with currencies and all, when we can't cover the entire amount. We take a few, and then for the remaining, we can't help it. We are exposed to it. Okay. So the agreed upon price by the buyer and the seller is called the futures price. And at the end of each day, all contracts have to be marked to the settlement price. I told you so. Settlement price, to be honest, guys, is not the last price, but it's like the last few trades average price. Okay. So settlement price, just make a note of that. The price the last few trades. Okay. So the number of futures contracts of a specific kind that are outstanding at any given time is known as the open interest. So just a word to remember that any futures contract, the number. So normally in a futures contract, it's like how many contracts we're investing in is what we see. Okay. So with futures margin accounts, both parties deposit a required minimum sum of money, initial margin. This required margin is typically less than 10% of the futures price. Okay, now I'll come to the margin part. Now, the beauty of futures is, unlike forward where you don't have to pay anything, if you want to enter into a future, you need to make a deposit payment. Okay, imagine something like, sometimes we notice like if you go somewhere, like maybe, let's say, what's the best example I give for that, like for deposit? Yeah, sometimes let's say, okay, you use like a swimming pool or something like that. Have you seen that you sometimes pay a deposit, which once you finish and when you come off, you can take that money out. So just like that, futures all as a deposit just to make sure that there is some sort of a guarantee that if in case something goes wrong, that money is always there to use it. Okay. So for that purpose, we should understand there are two things that we should keep in mind. One is called the initial margin. The other one is called the maintenance margin. Initial margin means as soon as you enter into the futures contract, there is a particular amount of money they'll ask you to deposit. Now, this amount is not an extra payment. So that's why when we are identifying the, like what is the exposure, we don't usually consider this as an additional cost. So it's not like an additional payment. It's part of what you will settle in the future, but you make a deposit just for a guarantee. So initial margin is typically less than 10% of the futures price. Like generally, it's a very small amount that we take. Then we have something called the maintenance margin, which is the amount of money that each participant must maintain in the account after the trade is initiated. And it is always significantly lower than the initial margin. Let me explain this to you, okay? When fund values go below the maintenance margin, a margin call gets triggered, requesting to deposit additional funds to bring the margin balance back to the initial margin amount. Okay, let me explain this to you like this. Let's say that initial margin, which is supposed to deposit, let's say, is, let's say, 10,000. Okay, so initially you deposit that money. Maintenance margin means the minimum amount that you need to maintain. So let's say, for example, your maintenance margin is 8,000. Okay, is that clear? So initially deposit 10,000, but you got to maintain 8,000, right? Now let's say you start at 10,000. So there is a daily settlement. So let's say on the first day, you encounter a loss of 1,000. Okay, maybe like I said, you buy and sell. So maybe based on that, you made a loss there. Now, when you make a loss of 1,000, what happens? The 10,000 now becomes 9,000. But still, there is nothing for us to bother about because it's still above 8,000. Now, maintenance is like the minimum value that we need to have, right? So it's still above that. Let's say what happens is on the second day, let's say you have a loss of 2,000. Now, what's the problem? From 9,000, when there's 2,000 loss, it becomes 7,000. Now we have a problem because we are supposed to have minimum of 8,000, but the moment it drops to 7,000, we have a problem because we have gone below the maintenance margin. Now, this is called a margin call. Okay, I don't know if you guys have watched this movie. It's a very popular movie called Margin Call. It's the same scenario. When that risk hits, there should be a margin call. So margin call meaning what? You should pump money back in if you want to stay in the position. Now, the reason for doing this is now, see, already there is a loss here. So if you don't pump anything, you're going to keep losses, and finally you're not going to basically have anything in that account. So where the moment you hit it below the maintenance margin, a margin call gets triggered telling to deposit money. And you should deposit money to the initial margin value, which means at this point, you need to pump in 3,000. Now, in some jurisdictions, guys, they say you can pump money to the maintenance margin, it is enough. But in the US standards, generally we say we pump money back to our initial margin. So then you again start at 10,000 and then this process keeps going. Let's say, for example, you make a profit and that amount is exceeding 10,000. You can remove that money out if you want to, or you can just keep it if you want to, whichever. Generally, people take it out, they can put it out for some investment, right? But it's up to you if you want to do that. Do you understand maintenance? And so the reason is it's a guarantee, but can you see how that guarantee works? So futures is not a very simple derivative. I think we have realized by now. Forward was a bit easy to understand, but don't worry, we will learn more into pricing and things like that. Then it gets a little more easier. But as of now, do you have any questions? I think I did see some questions. Let me quickly answer that. It has a question. Can you give an example of derivative that uses S&P 500 index as its underlying asset? Good question. Need to check on that. I can't exactly, nothing comes at the back of my head. I need to check on that, but there should definitely be because normally derivatives we have on indexes, but I can't recall exactly. Like there should be, it's like this right now. If there is someone who has invested in the S&P 500 index, then he can have a forward on that or a future on that. So ideally, I think a future on that should be definitely there. S&P 500 index futures should definitely be there. Yeah, but not an exact one from what I know. So buying and selling will be between different individuals, unlike forwards where it is dealt between two individuals. No, it's not individual. It's like an exchange. So just like now, when you buy shares, you buy from some other random individual, but you don't know that person, right? It's mass. So just like that, Here it's the same thing. So when you want to buy, there are people who are selling. When you want to sell, there are people who are buying. So it's a matter of like, it's the exchange that's doing it for you. That's why we say less counterparty risk. The amount you pump in can be the same as the maintenance margin, only 1,000. No, that's the thing. You can't pump. Now, the thing is, in some jurisdictions, it's allowed to pump money back of 1,000 to bring it to 8,000. But the US standards wise, it's always you pump money back to initial margin, and then from there, the process flows again. And if you come again, then there's another margin call that gets triggered. Right? Any other questions, guys? Any other questions? Anything else? Yeah, I'll give you like a minute or two. Can you all go through? If you want to make some notes, please do. I give that time usually for that. So if you want to make some notes of how I like it, how I put it over here, please do. Okay, there's another question also. Let me answer that. Can you explain the daily? Yeah. Okay, I'll explain the daily settlement concept once again. It's like this. So basically, now every day, as I said, there will be. Now, if you buy futures, you close it by selling. No. So if you had bought futures, then daily you will buy today, sell later. Next day you buy today, sell later. But actually, you're not buying and selling. You get my point. It's like a unrealized gain or loss that you're looking at. Okay. I'm not sure. Just to check, is there anyone over here who's trading in cryptos? I'm not motivating anyone to do so, but at the same time, I'm not discouraging anyone who's doing also. Okay. I used to, I've done at one point, but no harm in that. As far as you know the risk behind it, that's fine. But definitely something that you need to learn, in my idea, because it could be a future. So might as well just know what it is about. But yeah, just to check, is there anyone? Excellent. Okay. So if you're dealing in cryptos, I don't know which exchange you guys use, but if you use something like Binance or something like that, okay, like platform like Binance, you see that there is an option that you can enter into futures. Okay. So it's a bit risky. You can enter into futures with like leveraging, with a higher rate, even though you have less money, you can do that, right? But what I want to tell you guys is now with futures there, can you see that when you invest into a position, okay, can you see it's always showing you a unrealized gain or loss? How is that done? So which means if you are buying today, then it's automatically selling and showing you what your price will be, right? That's what basically this daily price movement is. Every day, it's looking at today's price against the end of the day price and telling you what the position is, so that you have an idea as to whether you're making gain or loss, right? So at the end of the period, it's going to be easy because you're already accounted for whatever the risk that's being considered. So it'll be just the final day that you have to look at. That's it. Now, does it make sense? Any questions on that? Does that make sense? Okay. Yeah, and also, yeah, please take your time and make a note if there's anything you want. Yeah, so I think one of you guys have asked, please explain mark to market. So that's what I told you guys now. Okay, I think there's another question as well. Let me see. Futures should not be focused on shares of particular company. It is focused on the entire. No, not like that. It doesn't necessarily have to be. I mean, futures you can also have on. Like I said, you even have orange futures. It can be based on any underlying asset. So it could be futures on interest rates. It could be futures on currencies, futures on stocks, futures on like commodities, oil, and so on. You all, I mean, oil futures are quite popular. So the price of it depends on that. So for example, now it doesn't, now the futures will have a separate price on its own, but it's not a separate, what do I say? It's always based on the oil price. Now, if oil price increases, futures price will go up, but it's like trading separately. It's not the same thing. You understand? So trading, I mean, investing in futures share, like, sorry, investing in the oil market and investing in the futures, which is based on that, it's two different things. Okay. Cool. So next we'll move on to settlement price. Settlement price is an average. Like I said, settlement price is not the final price. That's one of the mistakes that generally people make, thinking when we say settlement price, it's the last price. So it is always, remember, an average of the price of the trades during the last period of trading. It's like roughly like an average called the closing period set by the exchange. So it's basically like there is something called a closing period. So maybe like the last 10 or 15 trades, the average price of that. Many futures contracts have price limits, which are exchange imposed limits on how each day's settlement price can change from the previous day's settlement price. Okay, now if you remember, I told you about the daily limit, right? So normally there is a price limit that we have. Okay, now why we do that is in futures, otherwise there'll be a huge fluctuation when it comes to price. Now, for example, let's say when you don't have a price limit, the price might be like suddenly bouncing all the way up, all the way down. So the profit and loss is also like too much coming up and down. So we have like a limit so that the price doesn't change often, like to reduce the fluctuation, the impact of the fluctuation. Okay. So exchange members are prohibited from executing trades at prices outside the limit. So so you have to do it within that limit. Now, normally what happens is someone will quote for a price as another one quoting, so there should be some limit in that. If the equivalent price at which traders would willingly trade is above the upper limit or below the lower limit, trades cannot take place. Wait, I'll show you an example. So consider futures contract, which has a daily price limit of 0.04 and settle the previous day at 1. Now, if on the following trading day, traders wish to trade at 1.05 because of changes in market conditions or expectations, so they wish to trade at 1.05. Okay. But the problem is now the previous day's trading is 1. Now, when it is 1, guys, watch this carefully. It's always 1 plus. Now, the price limit is 0.04, which means on the upper side, you have 1.04. On the lower side, you have 0.1 minus 0.96. You get my point? So it's between these two prices, 0.96 and 1.04. It trades in between these two. You can't have anything executed more than 1.05. So that's what I say. If, let's say, traders want to trade at 1.05, because of the change in market conditions expectation, no trades will take place. You can't, right? You can't trade there because you have a limit, right? So the settlement price will be reported as 1.05. So even though you want to execute at 1.05, you can't. The maximum it will be is 1.04 for the purpose of marking to market. And then otherwise what happens? Can you imagine like when people want to, because this is like the price that's quoted, right? So it's like there is someone in an exchange. So when it's a share price, someone quotes saying he wants to go for this price. Now, when there's a limit, even though you quote, you can't. It will still stop at that point. So the contract will be said to have made a limit move, and the price is said to be limit up. USD. So basically, what happens? The contract will be said to have made a limit move, and the price is said to be a limit up. So we call it a limit up. So now what happens when we say limit up? Now we executed at 1.04. No? Now 1.04 will be the new price. Now from this, you need to see a new price limit. So new price limit will be on one side, 1.08. On the other side, it will be 1.0. You get what I'm trying to say? So this is what I mean by a price limit. So if there is a change in price, when you execute whatever the price at settlement price is, from there, you can establish a new band. So the bands can keep changing. So you're doing that so that, can you see the fluctuation is not much? Otherwise, you want to execute at a very high price, then if it's not controlled, it's going to be a problem. Okay, so same way, see, if market conditions had changed such that the price at which traders are willing to trade is below 0.96, 0.96 will be settlement price. This is talking about the first scenario, this scenario. right? So then that's called the limit down. So if trades cannot take place because of limit up move either up or down, the price is said to be locked limit. Since no trades can take place and traders are locked into the existing position. So that's what you mean by locked limit, meaning you need to be within the limit. Even if you want to establish something below that price or something above that price, not possible because it is locked. Okay, is that clear for everyone? That's what I mean by. So basically, this is actually connected to your mark to market. So remember, it's all about your mark to market. But just to explain you on, you know, like the limit that is available on that, the limit that's existing, mark to market. Marking to market, whatever. Any questions? Any questions? Guys, don't worry. I know that certain things over here might, be a little difficult to conceptualize initially, but don't worry, you'll get used to it. And to be honest, like some of these concepts which we're looking at in deep, in the exam when they're testing it, it's not going to be tested on all these areas. So when you do the questions, you'll know. These are, initially I'm taking you through all this for you to understand. Because I know derivatives is not a very easy concept to understand, but of course, you can try to grasp that knowledge and slowly you will get used to it. So that's the reason why I want to go to the depth of it and explain, rather than just, explain you an outlook and move on. Okay, because then it's easier for you when you go to level 2 and 3 also, you have a sound basic knowledge of what actually derivatives means. Okay, so I'll just explain how the band moves, right? So basically it's like this. When we say like how the band moves is, now let's say the last price is 1. Now when it's 1, now when they say that they have a price limit of 0.04, that means you like the up and down board, whatever the amount you need to add for the upper limit and the lower limit. So I added and showed you that it's 0.96 and 1.04. So what you need to do is once you do that, if you want to establish anything, like any trades you want to do it at any price above or below, you can't do it. The maximum it will go to will be the upper limit. Then what happens? It goes to the upper limit, then it takes that is the last price. From that, you establish a new band. So next day also, if it increases further, then it maximum can go to 1.08. So can you see in that case, you are trying to limit it by not making it expose too much up and down. So you have a limit on that. That's the purpose why we do it like that. So that you have some control on the way the price changes. Understood? Same way when it comes down, you have the same scenario as well. Is that clear now? Does that make sense? Yeah. And can you all? No, it won't change at the same day. Yes. Good. It doesn't change at the same day. Exactly. It's going to change on the next day because for that day, we have a daily price limit now. The next day, it can change if it still has a price which is establishing at that date. Because from that, it works again. So that's how it is. Yeah. Yeah, that's the lock limit is what I was showing now. So lock limit means it's locked as at that date. So if it's locked between 0.96 and 1.04, that's called lock limit. You can't go more than that. You have to maximum go for 1.04. Even if you want to establish 1.06, you can't. That's called a lock limit. Okay. Right. Any other questions? Can you have a look at this and let me know if anything else to clarify? Okay, all good. Yeah, so what we'll do, okay, just to give you a small, before you go for a break, I'll just give you a quick recap on and rather like I'll just quickly show you the difference between forwards and futures. Futures contracts trade, so we have studied this already, but just keep in mind. Futures contracts trade on organized exchanges, but forwards are private contracts typically do not trade, meaning they are OTC. Okay. Futures contracts are standardized, forwards are customized contracts satisfying the specific needs of the parties involved. Clearinghouse is the counterparty to all futures contracts, keep that in mind. But forwards are contracts with originating counterparty and therefore they have counterparty risk. So forwards have counterparty risk, I've explained it before. The government regulates futures markets. Forward contracts are usually not regulated and they do not trade in organized markets. So keep in mind that there is government regulation on futures because it's an exchange. But forward contracts are usually not regulated and they don't trade. So when you say usually, not that there is some forwards, especially when it comes to forward contracts, which are quite significant in terms of the value. There is some regulation happening there, but unlike futures, of course, it is an exchange which definitely is regulated. Okay. Right. So just to give you a small, like we have learned pretty much most, but just to show you the difference between the two. So even though pretty much they are fixing in the future, the way they do it is different, right? Okay, so we'll go for a break now. And when we are back, we will look at swaps and hold on, let me just check. What time can we? Yeah, so it's 12 o'clock now, no? So let's come back at 12:30. And nothing much, I just have swaps and then options. I'll be taking you all through a few concepts on, how a bit of identification of how each of these instruments have in terms of the buyer and the seller question. So as I said, this is a very basic idea initially, but then we'll also look at some pricing and valuation later. Okay, and then when you are done with this for today, I'll also quickly give you some questions. Let's see, depending on the time, if we don't have a lot of time, then maybe I'll give the questions next week. But let's see, I think we should be okay. So we'll come back at 12:30, and then after that we can complete the rest of the session. Any questions before we break? Any questions? Anything to clarify? Okay, yeah, cool. I'll see you guys at 12:30 then. Okay.
Okay. Shall we continue then? Let me just a minute, guys.
Okay. So now let's look at swaps. You guys can see my screen. Okay, now coming to swaps. Well, how swaps are different is now when it comes to a swap, it's like it's an sort of a, how do I put it? It's like an exchange that happens. So it's like basically now a simple example that I can give you is let's imagine you are someone who has entered into a loan where you're paying a fixed rate. Okay, so let me just give you an example. So let's say you are party A, okay, who is basically someone who has borrowed at a fixed rate. Okay. So now what happens is now you want to borrow in floating. Okay, now you are borrowed in fixed, but the problem is now you want to convert to floating. Like you want to basically borrow in floating. Now the issue is now if you want to borrow in floating, you need to sort of one way that you can do it is you need to pay off this loan and enter a new loan. But you know that's not easy because obviously you need the resources and the money for you to pay it back and then come up with a new one. So rather than that, what makes more sense is if you can have another party who can swap this payment for you. So this is like a best example of what I can give you for a swap. Okay. So you have a party A who is borrowing on a fixed rate. You have party B who is borrowing on a floating rate. Okay. But party A wants to pay on a floating rate because party A is thinking that he is expecting interest rates to increase in the future. Okay. So ideally, when you look at swaps, guys, we look at swaps on interest rates or we look at swaps on currencies. Okay. Now, in this case, our focus is going to be on interest rates. Now, when you take the floating rate, sorry, when you take the fixed rate, so the party A who is going to pay on a fixed rate, now you want to pay on a floating rate, no? So there's another party at the same time who wants to pay on a fixed rate. So he will pay you the fixed rate, which you will use it to pay your fixed rate. And he will pay the other party the floating rate, which he will use to pay for the other party. That's basically how this works. So that is what we look at in terms of the fixed rate and the floating rate. Does that make sense for everyone? Okay. So, for example, a swap is an over-the-counter derivative contract in which two parties agree to exchange a series of cash flow. So the thing with swap is no, it's just not one transaction. So then it's more like a forward rate, no? So it's just going to be only once, like you're going to exchange like this, it's going to be okay. But here we're looking at a series of cash flow, right? Because now let's say every quarter or every month, you need this sort of transfer to happen, right? So whereby one party pays a variable series that will be determined by an underlying asset or rate, and the other party pays either a variable series determined by a different underlying asset or rate or a fixed series. Sometimes, guys, it could also be a swap can also be done for fixed rate as well. Okay, now sometimes, for example, it could be like you want now, but ideally the scenario, the usual scenario is it has to be like a floating and a say a fix so that it makes sense for you to basically have a sort of a reason for you to enter into a swap, right? But the thing is, when it comes to when we say sometimes like the party pays either a variable series determined by a underlying by a different underlying asset or a rate or a fixed series. So that's what we say. It's either a variable or a fixed series. So basically, now one party who is paying floating, the other party who is paying a fixed. Swap agree to exchange. This is the important thing. A series of payments on periodic settlement dates over a certain time period. So example, quarterly payments or 2 years. So the good thing is swap is this is the best thing to use when you're looking for longer periods of time. So let's say something for like 3 years, 4 years. So then every quarter or every 6 months time, you can always look at a settlement which is happening. Okay. So at each settlement date, the two payments are netted so that only one net payment is made. Basically, what happens is at settlement, two payments are netted so that only one payment is made. Right? So the party with the greater liability makes a payment to the other party. And normally, what actually happens is what that means is now Now, ideally speaking, you have fixed and floating. Now, both of them should make a payment. No. So rather than that, what we can do is we can set it off and see a net payment. Same thing, right? For example, let's say if you take this A and B, if A is supposed to pay 5, okay, bring it. So let's say A is supposed to pay 5 and B is supposed to pay 4, then the effective rate is what? If A pays 1, that would do, right? Right? That would do. You get my point? So that is what we mean by we only have one leg. So generally, even though we have two legs where both of them have to make a payment, instead of both making payment, we just check that we make sure that one makes the payment. Okay. So the party with the greater liability makes a payment to the other party, and the length of the swap is termed the tenor of the swap, and the contract ends on the termination date. So we see that length of the swap as the swap tenor, like the period. Okay, so the length of swap is termed as the tenor. Okay, and remember, the swap contract ends at the termination date. So, like, let's say if you're looking at a swap for like 2 years, then at the end of the 2 years, your swap is done. Okay, that's what I mean by the swap. So basically, how is it similar to a forward contract? Well, there are some similarities. Swaps typically require no payment by the party initiation. So just like a forward contract, you don't have a payment when it comes to a swap. It's like two parties enter into it. Like I said, now here also, okay, let me ask you a question, just like what I did for forwards. Now, let's say you're a fixed rate. Okay, if you're a fixed rate, if you're paying a fixed rate, then why would you want to convert into floating? Like, are you expecting that interest rates are going to increase, or you're expecting interest rates are going to decrease? You get my question, right? So let's say you're paying on a fixed rate. Why would you want to convert to a floating? Do you think interest rates are going to go up or interest rates are going to come down? Can you put on the chat? What do you think? Why do you think you are paying a fixed rate? Is the question. Okay, so I see different answers. Some of you say increase, some of you say decrease. So keep in mind, if you're paying a fixed rate and if you want to convert to a floating, that means you're expecting that interest rates are going to drop in the future. Is that clear? Because if interest rates are going to increase in the future, then you will want to stick to your fixed rate. Do you understand? You will not want to change because you know that if you're sticking to a fixed rate, then you will not pay a higher interest rate even if it increases. On the other hand, a floating rate, those who are paying a floating rate will want to change to a fixed rate because they are expecting interest rates to increase. So they feel it's better to go to a fixed rate so that they don't have to pay that increase rate. Does it make sense? So keep in mind that that is the idea over here. Okay, so that's just like a forward contract. It doesn't have any payments. So it's just two parties can benefit. You or the other party can benefit, like just like for a forward. Stops are custom instruments. So again, just like remember, just like forwards is very important. They are customized instruments. You can customize the way you want. And swaps are not traded in any organized secondary market. But they are not traded in a secondary market, just like a forward contract. They are just over-the-counter markets. Like it's just two parties involved in it. Swaps are largely unregulated, again, just like a forward, right? That part of it is the same. Default risk is an important aspect of the contracts. Most participants in the swap markets are large institutions. So default risk is also an important aspect. You do have default risk because again, swap, the biggest problem is what your counterparty risk, just like a forward. What if the other party doesn't oblige to it? Because a swap only works if both of you all are able to oblige to it. What if you are ready to make the payment, the other party isn't? Most participants in the swap markets are large institutions. So generally, swaps are very rarely used by individuals. Mostly these are like big institutions who end up using swaps. And individuals are rarely swap market participants. So that's the thing, same meaning again. Okay, so these are some important, sort of like similarities that you can see in both. Any questions on swap? Any questions? Any questions, guys? Shall I move on then? Right. So just a few more concepts on that. A plain vanilla interest rate swap is where one party makes a fixed rate interest payments on the notional principal amount specified in a swap in return for a floating rate payments from the other party. So the basic idea about, where you're swapping a fixed rate for a floating rate, that's called a plain vanilla interest rate swap. The reason is you also have swaps where it could be like an index and could be like a floating rate, something like that. But a plain vanilla interest rate swap, this means that you're looking at a typical swap where you're looking at one side who's paying floating, the other side who's paying fixed, and then swapping each other. Okay. So in a plain vanilla interest rate swap, the party who wants floating rate interest payments agrees to pay fixed interest rate and has to pay the fixed side of the swap. So keep this in mind. This wording is very important because you can be tested on this. Like in an MCQ, they can ask you this, right? So in a plain vanilla interest rate swap, watch this. The party who wants floating rate interest payments and who agrees to pay fixed rate. So let's say you're someone who is currently paying floating, but you want to pay fixed. So then you are taking the pay fixed side of the swap. You get my point? Because you're the party who is going to receive floating, which you're going to use to pay for your loan, but you're going to pay fixed to the other party. And the counterparty who receives the fixed payments and agrees to pay variable interest has the pay floating side of the swap and is called the floating rate payer. Get my point? So this pay side, pay fixed or pay floating means when you are in a position that, in the swap, when you are making the payment. You get my point? So, so the same way, so if you're like the fixed rate party who's paying floating, then you take the pay floating side. But if you are the party who is actually paying in floating and now you're paying fixed because of the swap, then you're taking the pay fixed at the swap. So it's basically the swap that tells you whether you're paying or whether you're paying the floating or paying the floating or paying the fixed. Sorry. Okay. So the payments owed by one party to the other based on notional principal that is set in the swap contract. So usually the principal is of course stated already, right? So it's about basically what matters here is guys the rate. So what we are doing, the whole point of this is the interest rate. So a basis swap involves trading one set of floating payments to other. So we also have basis swap. Basis swap means we are floating for another floating. That is also there. But don't worry, you are not going to be tested on that when it comes to exam. But just get an understanding that sometimes it could be situations where, because now remember, it can even be like this, right? Now, when you take floating rate, now you usually take fixed rate. The beauty of fixed rate is it's just a usual rate. Okay, so let's say you have maybe 7%, 8%, that's 6% or something. That's called fixed rate. But we know floating rate, we have various varieties, meaning now floating rate is, for example, we can code it as LIBOR plus 2%. Okay, or it could be based on something else, right? It could be a LIBOR minus 2%. It could be like, like another country's one, like for example, Hong Kong, they use the HIBOR, okay, Hong Kong interborrowing rate. Okay, or sometimes it could be just a base rate plus 3%. So floating has different varieties in which they can, fix it. So the idea there is like you might have two floating rates, sometimes a swap happening because it's based on different, it's on different basis. So basically, in keeping that in mind, there could be chances where you can even do that. So that's why it's called as a basis swap, because when you're swapping floating rate payments for another. But plain vanilla interest rate swap is where the usual one, where you have a fixed and you have a floating on the other side. Okay. Okay, there's a question in a swap. Do the ownership of the agreement exchange between parties? No, there is no agreement on ownership. It's just the cash flows. Yes, it's just going to be your payments, your interest payments. That's all. You're not going to basically. Now, when you look at a plain vanilla interest rate swap, the whole idea is that you're basically you're doing this in order to get exposed to a. Let's say if you're a fixed party, you're doing this to get exposed to a floating. That's the objective here. Okay. Does that make sense? Any other questions from anyone? Any other questions? Any other questions? Okay. Right, and we'll move on to options. Right, now, options, okay? It's basically like a forward. Imagine like a forward contract where this time you have a choice. Think of it as something. That's the easiest way to remember an option, okay? An option is a derivative contract in which one party, the buyer, pays a sum of money to the other party, who is the seller or the writer, to receive the right to either buy or sell an underlying asset. Now, this is the most important word over here. That is the right. You see that word, the right. This is very important because now, if you look at a forward contract, we say it's an obligation. Okay. Now, a forward, remember, is an obligation. The obligation means, guys, no matter whatever the rate in the market is, you have to go with the forward rate. That's what I said. No matter whatever the rate, whether it's 20 or 25 or 30 or 50, whatever, you still get the 25. But here, you have a choice. If you get a better rate in the market, you can stick to the market rate. But if you want to use your option, you'll use it. Okay. So at a fixed price, either on a specific expiration date or anytime prior to expiration. The good thing here is you also have the scenario where I'll teach that later. You can even exercise before the date also. For example, you are looking at an option where you're going to exercise in, let's say, 3 months' time. Before 3 months also, you have the chance if you want to sort of exercise. That is also available. Okay, does that make sense? Is that clear for everyone? So the difference here is, now let's say, for example, you want to, let's say the same situations. Let's take company A who is looking at buying, let's say he's looking at buying, let's say an asset. Okay. So let's say today's price is 25. Let's say there are 3 scenarios. Okay. So one is, let's say 20. The other one is, let's say 25. Okay. The other one is, let's say 30. Okay. Understood? So let's imagine today the price is 25 and you have an option. Okay. We say normally an option, we say the word strike price, the price. Okay. We have a strike price of, let's say 25, just like the previous. Now, can you all tell me, now you have an option that you can choose which is good for you. You go with that price. Can you all put me on, can you all put on the chat? It cannot put for me. What are the prices that you will go for or rather the buyer will choose? So for one, what is it? Will it be a 20 or will it be a 25? For two, is it 25 or is it's the same? Okay, 25 or is it 3, 30 or 25? Can you put that on the chat? Just say 1, 2, 3 and just put the prices. At what price do you think you want to buy? Okay. So I see that. Okay, good. So I think majority of you guys have got the answers right, looks like. So let me explain you guys. Okay, so the first one is if it's at 20, if you have an option, right? The price is there is a 20 price, sorry, in the market, and your option price is 25. Obviously, anyone in the right mind will always go for a 20, right? You will definitely not go for a 25 when you can buy a 20, no? That's the thing with an option, okay? So you'll go with 20. And if it's a 25, then you're looking at, it doesn't matter basically whether you're going with that or the option, so it's 25. If it's 30, definitely you'll use the option and buy a 25. Now, this situation where you use the option, we use the word exercise. This means you're using the option, okay? So instead of saying using, you always use the word exercise. Here, when we don't use the option, when you go with the market, we use the word lapse. Keep that in mind. Okay, so when you don't use the option, then if you're going with whatever the market price, that's called you're lapsing the option and you're going with the market price. But if you're using it, that's called exercise. Okay, is that clear? Right, so basically, the owner of a call option has the right to purchase the underlying asset at a specific price for a specific period of time. So basically, the person who wants to buy in the future will go for a call option. Is that clear? So remember, if you're going to buy in the future, let's say the scenario which I gave you above is a call scenario, meaning you're going to buy in the future. The same way the owner of a put option has the right to sell in the future. The right to sell the underlying asset at a specific price for a specific time period. So sell in the future. Understood? So basically the owner of a call option has a right to purchase. So basically the call option person is going to buy in the future. The put option person is going to sell in the future. Is that clear? Does that make sense? Okay. So that is a question. Isn't it the other way around? Meaning? No, it's correct, right? So because now when your price in the market is 20, right? When you have a price to buy at 25, why would you buy at 25? You would obviously buy at 20, right? You will buy in the market at 20. You will not use it. So that's why you're lapsing it. But if the price is at 30, definitely you'll use it and you will buy it at 25. Because when using the option, you buy it at 25. Is that clear? Yeah, for 1 and 3, it's 20 and 25. Yes. Okay, got it. Yeah. Is that clear? I think they are sometimes like just don't get too like confused on that. The idea here is when the market gives you a cheaper rate, you will buy for that rate. But if it's sell, it's the other way around. If it's sell, you obviously want to, no issues. Yeah. If it's sell, you obviously want to sell you are to sell at a higher rate. So then it might be you exercise at 30, you might lapse at 20. Sorry, you in that case, you will exercise at 20, you lapse at 30. So it will work the other way around. Okay, so remember calls and puts is clear. So if you want to buy in the future, it's called a call option. If you want to sell in the future, it's called a put option. But remember, this is the key thing. Now, if you are going to buy in the future, you will buy a call option. When I say the word buy a call option, you're going to hold a call option. If you're going to sell in the future, you're going to buy a put option. That doesn't mean you sell a put option. You get my point? Put means to sell. So you're buying the option to sell when you want to sell in the future. You're buying the option to buy when you want to buy in the future. Okay, so that is what we are looking at over here. Okay, does that make sense to everyone? Okay, so the idea here is that the buyer is known as the option holder and the seller of the option is called the option writer. The simple idea is now the buyer of the option holder, we call him as the buyer is known as the option holder. Sorry. Option holder. He's holding the option. And the seller of an option is called the option writer. Now, if you're going to buy the option, there is someone selling the option for you. So there's someone who is also selling the call option for you. You get what I'm trying to say? Now, you're buying the call option, but someone's selling. Now, that is not the put option. That's a different thing. Put option is you want to sell in the future. There is a seller who is selling you that option also. You get what I'm trying to say, right? So that you're very careful with an option. Okay. So the price of an option is also referred to as the option premium. Now, because of that, obviously nothing comes for free when there is some advantage in that. Okay. Obviously, as Sri Lankans, we all know very well, if you're getting something for free, there is definitely a catch there. Okay. So just like that, in options, there is a premium involved. So because you have a right. But whereas a forward, you don't have it because you don't have a right, no matter whatever happens in the market. Now here, you have upside potential as well as you can protect the downside, right? When it comes to an option. So definitely, that's the reason why you have an option premium. You have something that you have to pay. The fixed price at which the underlying asset can be purchased is called the exercise price, also called the strike price, the strike or the striking price. Now, that word exercise price is the usual word we use, but of course, you also have other names, as you can say strike price, strike, or you can also say striking price. So various words that we can use for that. Okay. American options may be exercised at any time up to and including the contract's expiration date, right? So American options is basically exercised at any time up to and including. Okay, this is what I told you. Remember, option. There are some options you can exercise before the expiration also. Like for example, let's say an option is going to now let's say you have an option for 3 months in 3 months time that you can use. But there are two kinds of options. One is called, I explained over here, but I'll just show you here as well. So one is called the American, and the other one is the European. Usually options when you're looking at, guys, they're usually European options. Okay, the usual options are European. Okay, but American options means you can exercise before. Okay, so for example, let's say you have an option where you have today, and the option is, like it's basically in 3 months time, but you can even exercise before that, right? But if it's European, you're looking at today, and if it is in 3 months, it has to be exercised in 3 months. You get it? It has to be exercised in 3 months. You can't exercise it before. That's what I mentioned to you all. American options may be exercised at any time up to and including the contract's expiration price. European options can be exercised only on the contract's expiration date. So keep that in mind. So let me ask you a question, just a common sense, okay, based on this. Now, because American options is giving you that option to exercise, now it means before and you can exercise on that same day also, but you have the choice. But European, you can only exercise, you have the choice to exercise, where you can exercise or not, but you can only do it on that day. You see the difference, right? Now, both options have the right. You can exercise, if you want to, but this gives you the option to exercise anytime you want to. Which you think should be more expensive? Should it be the American one or should be the European one? What do you think should be more expensive, ideally, based on this concept? Which one do you think should be more expensive? Just a random question. Very good, excellent. So definitely, like I always say, that's the beauty of being Sri Lankans. We all know that no matter what, nothing comes for free. So if there is an American option which is giving you that price, which is giving you that benefit, definitely it should be priced higher, or it should be the same or higher. It can't be less. That's my point. Okay. Like it can't be less, it can be the same or it can be higher. That's what I need to understand. Okay. It can't be less, it should be the same or it should be higher. Okay. Right. So that is what we look at in terms of options. Okay. So another concept is long call. Okay. Now, like I said, long means what? If you're buying. So if you buy the call, meaning long call, is the buyer of a call option. And like I said, he has the right to buy the underlying asset. Now, if you're a call option buyer, you have the right to buy the asset. Whatever it is, you can make a choice. If you get a better rate in the market, go with that. If you think the market is bad, you have a better rate here, you go with your rate. You go with the exercise rate. Understood? Short call, on the other hand, is the person who is selling you this call option, or someone should sell you for you to buy, that person, the writer, is taking the short call. But for him, he has an obligation to sell to you. Is that clear? Now, you have a right. You can choose or not. But the seller, he has to pay, or rather, he has an obligation. He should do whatever you want, right? For example, if you say, I want to exercise it, he should be able to give you that price. If you say, I want to lapse it, then both of you all stay silent. You would go and buy the market price. He will just be without doing anything. So he has an obligation. He can't make a choice. Now, for example, let's say you want to exercise. He doesn't have a choice to say, no, you can't exercise. You can't do that. That's why you paid him a premium. That premium is non-refundable. Whether you use the option or not doesn't matter. You pay it. That's it. Whether you use the option or not, it's not refundable. So that's the catch there. If you pay the premium, that's it. Forget about it because it's paid and done and dusted. But he doesn't have a option when it comes to that. Does that make sense? Okay. So that's what basically the idea here is. Okay. And same way for a long put, the buyer of a put option, he has the right to sell the underlying asset. In a short put, the writer or the seller of a put option has the obligation to buy the underlying asset. But let me ask a quick question. Okay, let's take a call option buyer. Okay. What do you think? What is your view on the stock for you to enter into an option? Now, you guys know, I told you for a forward contract, the view for you to enter is you're expecting let's say you are a buyer, you're expecting the price to go up. That's why you enter into a forward contract, now, just to make sure that you get the forward price. But in the same way, what is the idea of you buying an option, a call option? Do you think the price is going to go up or go down, or what? What is the idea? Why do you think you go for a call option? You can put the answer in the chat. Yeah. What do you think? Okay. Now I see answers. Most of you guys are saying prices will go up. Okay, if the price is going up, why would I go for an option? I could have just gone for a forward contract, right? I mean, why am I going to pay something and go into an option when I can just go for a forward contract? If I know for sure price is going to go up, why would I go for it? Perfect. Good answer. One of you guys say, in a scenario of price volatile period, to avoid exchange risk. Very good. The idea behind going for an option is because you're expecting volatility. Now, let's say in a scenario where share price is very volatile and you're not sure, is what I would say. You're uncertain. Now, you want to have some protection, but you don't have a certainty on the direction because maybe your price is very volatile. It's going up and coming down, just like a snake, it's very volatile. So in that case, you can't take a risk. So because of that, you would go for an option. Excellent. What about the person who is writing the option? Why is he basically writing an option? Why is he taking that risk and writing an option when he has a huge risk there, right? Because now he is like, no matter what you want, he will give you sort of, because he has an obligation. You make a choice, he will give you. If you don't want it, he can just stay silent. But why do you think he is doing that? What is his motive? Is he expecting the price to go up or come down, or what is it? What is the expectation? The first one, now you understood now because it's very volatile, you're not sure, so you enter into it. Why would he enter into it? Anyone? Anyone knows the answer for that? Okay, the answer for that is he's actually expecting the price to drop in the future. But he has some certainty that price will drop. So he knows that if he sells you, he's going to get the premium. So he's happy today it gets the premium. And if the price drops, he knows you will not use the option. Because if the price drops, he knows you will go to the market and you'll buy. You won't buy from him. So he's safe. He has the option. You won't do anything there. He has already got this premium. Understood. It's a big risk that he's taking but unless he's very certain that he has a view that the price is going to drop, if he knows the price is going to increase, then that means he's being really stupid because he knows that it's going to increase and definitely they are going to exercise. So why would he do that? But here the situation is that he knows that the price is going to drop, so he is trying to capitalize on that. Does that make sense for you guys? Does that make sense? Right. So the same way for a seller, he's uncertain whether it will go up or down. So he's going with that. Sorry, not a seller. Say for a put option. But the put seller is expecting the price to go up. So he knows if the price goes up, definitely you will not make use of it. You will go for the market. So then he is benefiting by that. So it's a matter of capitalizing. Is that clear? Can you skim through that and let me know if you have any questions, guys? Please put on the chat if you have any questions on that, please. Okay, there is a question asking like who decides on the price. Actually, that I will come to later. Like I haven't done pricing yet, but there is a way that we do this pricing. There is like a concept that we do for pricing. So that I'll teach you guys later. Yeah, we'll be learning how the pricing works. Yeah, guys, just get me. Yeah, just get me a minute. I'm just out of power. I'm just trying to find a socket because there's a bit of a power outage over here as well. Just get me a minute. Hold on. Yeah, cool. Okay. So is that clear? Any questions on that, guys? Anything you want to clarify on that? Okay. So the next thing that we're going to look at is, let me share my screen. Okay. So what we're going to look at next is, what does it mean by moneyness, and how do we decide when it comes to, um, an option? Okay. For example, let's take two scenarios where you're going for long buy, or rather, let's say a long put option, and the other one is we're going for long on a call option. Now let's imagine your strike price is greater than your market price in this scenario, first scenario. So strike price meaning your exercise price is more than your market price. Then in the put option terms, you're in the money, right? Because why? Now, if you can, when you say in the money, that means if you're going to exercise the option, that's called in the money. So if you have a price that you can sell higher than the market price, you become in the money. Okay. On the other side, if you look at a call option, it's out of the money. Why? Because if the strike price in the market, sorry, if your price is higher than the market price, you won't use the option, right? Because your market price is cheaper. If you don't, you make use of the option, that's called out of the money. Meaning you are paid for the premium and you are paid for the option, but you're not using it, right? But if your strike price equal to market price, we call it as at the money. It's just there. And same way, if your strike price is less than the market price, your put option will become out of the money now, but a call option become in the money. Simple. Okay. Does that make sense? Any questions on that? Anything you want to clarify? Any questions on that? Any questions on that, guys? Anything that is not clear? Okay. So I've just given a small example there also. Now, let's say, for example, if you're looking at Apple, let's say the price is 155. So let's say if the strike price is 145. If your strike price is 145, but the Apple's share price is 155, then for a call option, you're in the money. Why? Because it's good for you because you can buy at a cheaper price. So you're in the money. But put option wise, no point because you might as well go when you're selling it, you want to sell for the higher rate. So go for the market rate. So if it's 150 again, it's in the money and out of the money. But at 155, you see it's at the money. And on the other hand, if you look at this part of it, basically it's out of the money when it comes to when it is 160 for calls. For puts, it's in the money. Why? Because you would want to sell at a higher rate. So it makes sense to sell at 160 than selling at 155. And the same scenario applies here as well. Okay. Any questions, guys, on that? Anything that's not clear so far? And I think there was a question I couldn't answer that yet. Yeah, look at that question. Okay. Under option, always the seller takes the risk, not the buyer. Seller may have either loss or nothing, but generate a profit. Is that yes? To be honest, for a seller, is the one who is taking the most risk, and that is the reason why he's charging that premium also. So ideally, so it's like just imagine like an insurance company. So an insurance company charges you a premium, but they take a big risk, right? Because if you meet with an accident, sometimes the amount they claim for you is more than what you would have paid in premium also, but can't help it. And that's a scenario here as well. You paid a premium, the amount that the party who paid for it can benefit could be much higher. But the risk there is now basically if you now that's what you see. Sometimes you would have paid insurance for a vehicle over the last 10 years, but you would not have met with an accident at all. So then basically they are benefiting because they just have that premium and you are not claimed it. You understood that sort of a thing. So that's the same situation here as well. So the seller is always benefiting from what he is holding. So in a sense, like the seller knows that for him, he will benefit if he's like his expectation, the price is going to drop. Let's say if it's call option, right? But otherwise, he knows very well that the party who he has sold to has the option. So he is supposed to just oblige to whatever he wants to do. Okay. Right. So that's what if you look at this, consider call option as a premium of $5 and strike price of 50. Okay. Now imagine you're paying a premium of 5 Let's look at this example. Now see, look at this graph. This will be much more clear for you now. The maximum loss for the buyer of a call is the loss of $5 premium. Now look at the call option buyer. Now look at you in the situation we are going to buy in the future. The maximum loss for you, okay, is what? The maximum loss that you can have is going to be $5, right? Okay, because maximum that you will lose is the 5. Why do I say that now? Because you know very well that whatever it is, you get the best rate. Now, even if the market is better, you go with the market. If the market is bad, you go with your price. But maximum you will lose is what? If you don't use the option, maximum you're losing is whatever the $5 you paid as premium. That's why if you look at this over here, now see the person who's taken the long call, can you see the maximum loss that he has is always the -5 because he can't go anything below. This can't happen. Okay. But whereas on the other hand, if you take let's say so another thing is the break-even point for the buyer and the seller is the strike price plus the premium. Now the break-even point is ideally this point. Why do we say it's strike price plus premium? See, the reason is now this is the point, right? Because anything now, for let's take a call option, you actually benefit, your actual profit is when the price goes above 55. It's true, like above 50 itself, you will exercise the option. But you paid premium of 5 also. Now, if you consider that also, anything above 55, it's jackpot for you, right? Because you are looking at whatever it is, you will just make use of it. For a short call, can you see his maximum profit he can gain is also +5, right? He can't gain anything more. But the loss he has is crazy because the profit he has will be the loss for you. You get what I'm trying to say? So that's the idea over here. Okay. Clear, right? Now, the next thing is the profit potential to the buyer of the option is unlimited. That's what I told you. So this is unlimited. This can keep on going. Okay. And conversely, the potential loss to the writer is unlimited. This can also keep on going down. Okay. So the call holder will exercise the option whenever the stock price exceeds the strike price at expiration date. That we know whenever it exceeds, he will. But I just told you the profit wise, it has to break even because you need to add that and see. You need to add your premium and see because you have paid a premium already for it. The greatest profit the writer can make is $5 premium. So the same way, like because your maximum loss is $5, the greatest profit that he can make is also the opposite, right? So basically, it's a simple mirror image that you're looking at. Mirror image like this. Any questions on that? So this explains a lot of things for us. So you can be tested on this, like various things, for example. So if you have, so just remember that for the seller, he's the one who's taking the most risk, and that is why he's charging that premium. So that's his maximum profit also. But his loss is unlimited. But when you take the buyer, he is of course safe in terms of I mean, his upside is unlimited, but his downside is limited. Okay, because he can protect against it. But the maximum loss he can make is the premium. That's all. If you can remember those fine-tune points, should be sufficient. Okay, any questions from anyone? Any questions? Okay, perfect. So the same way, I've also just put up something for a put option. So very simple. Consider a put option the premium of $5 and a strike price of 50. Okay. Sorry, can you hear me? I think there was a small issue with the app. Let me share my screen once again. Yeah, can you guys see my screen? Can you guys see my screen? Okay, yeah, thanks. So basically, yeah, can see now, yeah? Can you see it now? Okay, great. So basically, the same situation, let's look at for a $5 premium you're paying for a put option, a strike price of 50. The maximum loss for the buyer of a put is the loss of $5 premium. So again, coming to that, the maximum loss for the buyer is also going to be the $5 premium. Okay. The maximum gain to the buyer of a put option is limited to the strike. Now, to be honest, even though for a put option, just like for a call option, we can say that the upside is unlimited. For a put, to be honest, the thing is, well, you're looking at a down. I mean, when you look at the price, it's the below part. No, so can you look at this? So still, there is some limitation there. So the maximum gain you can make is also 50 minus 5. Considering that your price can maximum drop to 0, it's going to be 45, right? Now, see, it should be 50 minus 5 because maximum you can drop is 0, no? That is this end of it. Can you see that? Now here, it's limiting at this point. Now, you can't allow to go because of the 0. Now, sometimes there are certain instruments that can also have like minus values. So in that, it's going to be more. But in a usual instrument where the minimum value is 0, the maximum profit they get will also be within that 45 range. The potential loss to the right of the put is the same amount. So obviously that will be the loss. So again, input, there's a slight difference in it cost because of that. The break-even price of a put buyer is the strike price minus the option premium. So obviously there it was added, but here it will be minus. So this will basically be the break-even. The greatest profit the right of a put can make is the $5 premium. Understood. So the greatest profit the right of the put can make is a $5 premium. So that's the biggest profit that we can look at. Okay. So you can't make, the writer can't make anything more. So now imagine the put option, the writer, if you can make a note of this, that's great. Okay. So making your own notes, it's always good. So that's why whenever I write, I give you guys a bit of time also. So please write down if you need anything for your understanding as well. So the writer in a put option, the maximum profit he can make is the premium. The maximum loss is also limited to the strike price minus the premium, because considering that it can drop maximum to 0. Same way for the option holder, the maximum loss he can make is obviously the $5 premium, and the profit is going to be capped at the 50 minus the 5 in this scenario. The basically the whatever the strike price minus the premium. Okay, does that make sense for everyone? Does it make sense for everyone? Any questions, guys? I'll give you all about 2 to 3 minutes. Can you skim through all that we have learned so far, especially on these last 2 slides? If there's anything not clear, please let me know. I can clarify that for you all, and we can move on to doing questions. Okay, so I'll just send you guys the questions, but please go through and let me know if you have any questions before that. Yeah. So guys, I have put some questions on WhatsApp. I hope you guys can grab it from there to do the questions. So what you guys can do is let me hold on, let me share my screen. Yeah, so these are the set of questions, guys. Can you all, so these are all based on what we learned today. Can you all quickly do these questions? So it's basically 1:34 now. So what I'll do is I was thinking like I'll give you all about, so it's about 18 questions. So I think if you guys can take, um, you know, yeah, so you need at least like about 25 minutes at least. Yeah. So it's fine if you guys can finish it off by 7. That'll be great. Then what we'll do is maybe like 1 or 2 questions I'll quickly discuss with you all. Or maybe even like we'll see the timing and we'll see how much we can go ahead. And then after that, the others we can continue in the next class and finish it off. Okay. But once you do these questions, you'll have an idea what we have studied and whether you are able to apply it when it comes to exam. Because for exam, it's all MCQs. So you don't have to worry too much about, like writing anything here, but make sure that you know your concept well. Okay, so please attend this. I've sent it on WhatsApp also. And I'll give, yeah, by 7 o'clock, we will discuss. And also, sorry, there was one more question, I think. Okay, put option graph, please explain it again. Okay, I'll quickly go through that again once more. Quickly, I'll go through it once more. 1 second. Okay, so basically for put option, nothing much. Don't worry too much about just because it was a little different from the call option. It's nothing drastically different. The idea is the same. Okay, you are paying a premium. So for you, the maximum loss you make is the premium, but the other party, he has to, like that's a maximum gain he can make. But why here the difference that comes is because obviously now put means what you're looking at selling high in the future. So the price max now you will benefit when the price drops. No, so maximum that you look at the asset price dropping is 0, right? So the maximum you can benefit is dropping to 0. But if you look at for the call option, it's about increasing. Increase can go from 0 to even like 1,000, a trillion, or whatever, right? So that's the ideology there. That's how the difference works. Otherwise, it's all the same. It's just because of that restriction that we have. Is that clear now? Makes sense. Okay. Yeah, perfect. Okay, so please do those questions, guys, quickly. Yeah, no worries. Okay. So hope you guys were able to do the questions. Let's quickly discuss a few questions. And after that, what we'll do is the rest we can continue next week, and then we'll also work on the other chapters. Just a minute, let me share my screen. Just give me a second. Hope you guys can see my screen, right? So the very first question, which of the following statements most accurately describes a derivative security? Okay, a derivative security, is it A, always increases risk? Okay, so how we'll do this is, so usually what I'll be asking you guys, like what I generally ask my students is that I'll ask you guys to, if you can put the answers on the chat. So let's say, for example, when I read the question out, you can say one, and whatever the answer, A, B, or C. Okay, so I'll give you all about maybe like a few seconds for you to quickly put the answer, and then just have a quick look, and then I will explain you guys what the correct answer is, and I'll give you the explanation behind it also. Which of the following statements most accurately describes derivative security? A derivative A always increases risk. B has no expiration date. C has a payoff based on an asset value or interest rate. That's the correct answer. A, B, or C. You can put the answer in the chat. Very good. So I think everyone has got this right. The correct answer is C. And I think it's quite clear also because I've been explaining this, saying that it has a payoff based on the asset value and interest rate. Why is it not A or B? The reason why it's not A is always increases risk, not really. I mean, derivative does have risk, but not always increases risk. No expiration date is wrong because we know it does have an expiration date. Okay, guys, when answering, there are two ways to answer. Let me explain you that also. One way is which, when you look at the options, you will know as soon as you read it, you will know this is the answer. Sometimes it might be difficult because most of the time the confusion is between two answers, which is correct. You'll always think about that. So then the best way is try to eliminate. There'll be one answer 100% is wrong. So cut it off. Then think between the two and then you can decide which one. Which of the following statements about exchange traded derivatives is least accurate? So be careful with these terms because if it's least accurate, they're asking for the wrong one. Exchange traded derivatives are liquid, are standardized contracts. They carry significant default risk. What's the correct answer? Least accurate is what they wanted. Okay. Perfect. So again, I think you guys have got it right. Very good. The correct answer is C. Because why? We know that one of the best features of the exchange rate derivative is that it doesn't have counterparty risk. So when they say significant default risk, that is wrong. Liquid is correct. They are standardized contracts. We say normally they're liquid. The reason is because they're standardized and they are regulated. They're generally highly liquid. Which of the following derivatives is a forward commitment? Stock option, interest rate swap, or credit default swap? Think carefully, guys. What is the correct answer? Very good. The correct answer is B, because the reason is why stock option, an option we know is a contingent claim, not a commitment. Because why? You have the right, not an obligation. So we know this is wrong. And credit default swap is also, we know very well that it is a contingent claim. So the only one that you can look at here is the interest rate swap. A custom agreement to purchase a specific T-bond next Thursday for $1,000 is A, an option, B, a futures contract, C, forward commitment. That's the correct answer. A custom agreement to purchase a specific T-bond next Thursday for $1,000. Yeah, so a custom agreement, they say anyway, custom agreement to purchase specific T-bond next Thursday is 1,000. So definitely we know if it's a custom agreement, A, is it option, B, futures, or C, forward commitment? So definitely it can't be a custom agreement, can't be a futures. No, so you can eliminate futures out. Within option and forward, so they say that to purchase a specific T-bond next Thursday for $1,000 is definitely a forward commitment, right? Because you're looking at a specific T-bond next Thursday, so it doesn't look anything of an option. So interest rate swaps are A, highly regulated, B, equivalent to a series of forward contracts, C, contracts to exchange one asset for another. That's the correct answer. Interest rate swaps. Good. So I think everyone's got that right as well. So interest rate swaps are highly regulated is wrong because they are custom agreements, no, not regulated. Equivalent to a series of forward contracts. We normally say that, no, it's a series of forward contracts because we say it's over a tenure and we're looking at like multiple periods in between that. Contracts to exchange one asset for another. Well, the correct way is like it's not always one asset for another. Okay, so that's why that is wrong, but equivalent to series of forward contracts makes more sense. Question number 6, a call option is A, the right to sell at a specific price, B, the right to buy at a specific price, C, an obligation to buy at a certain price. A, B, or C. What do you think is the correct answer? Perfect, excellent. I'm very happy to see you guys are like answering everything well. The right to buy at a specific price. Call option is definitely the right to buy. The right to sell at a specific price is wrong. That is a put option. So this will ideally be a put option. And an obligation to buy at a certain price is a forward contract, no? Or a future, forward or a future, but it is not a it is not an option. At expiration, the exercise value of an option is, so remember the expiration, the exercise value of a put option is positive if the underlying asset price is less than the exercise price, 0 only if the underlying asset price is equal to the exercise price, negative if the underlying asset price is greater than the exercise price. It's a little tricky, I would say, this question, but let's see if you guys have got it right. Okay, so that's why I see there is a confusion between some saying A, some saying B. Watch this very carefully. It's a little tricky. I'll tell you why. So we are talking about a put option, right? It is positive if the underlying asset price is less than the exercise price. Well, I think that should work. A seems fine, but let's see why the others are wrong. Okay, A is fine because asset price less, the underlying asset price less than exercise price means you will definitely use the put option, which looks like that is correct. 0 only if the underlying asset price equal to the exercise price. You know why that is wrong? 0 only if it's what it says, right? It is 0 correct for asset price equal to exercise price. It is also 0 if the asset price is greater than the exercise price, because we know in options you have nothing called a negative value. That's why you see C negative is wrong because you have nothing called negative value. The moment you see negative, you can cut it off. Because that's why it's an option. You can choose. You never choose something negative. That's why B is out because it says the word only. You get what I'm trying to say. So that's why the correct answer is A. So those who went for B, I think y'all would have gone with the assumption that if it's equal, yes, it's 0, but because it's only. It's not only, it's also if the asset price is greater than the exercise price. Okay, at expiration, the exercise value of a call option is A, the underlying asset price minus exercise price. B, the greater of 0, the exercise price minus underlying asset price. C, the greater of 0 or the underlying asset price minus exercise price. What do you think? The exercise value of a call option. A, B, or C. Here also, I think that I see a bit of a confusion. Some say A, some say C. Majority say C. Okay. Exercise value of a call option is the underlying asset price minus the exercise price. Okay, so is it asset price minus exercise price when you look at call option value? It should ideally be yes. A seems correct, no? Why? Let's see. Greater of 0 or okay, but then the other option seems better because the greater of 0 or the exercise price minus the underlying asset price. Rate of 0 or the underlying asset price minus. Yes, C should be the correct answer because the reason is, guys, now I know like A seems correct. Okay. So A seems correct. So let's say, for example, the underlying asset price minus exercise price is correct. It's not wrong. But it's always the greater of 0, the underlying asset price minus exercise price is correct. The reason is because, as I said, an option value is always generally 0 or above. You can't have anything below. That's why I use the word greater of 0. Okay. Okay, so if should use values to explain 8, it's going to be like this now. So when I say, so let's say my asset price is, let's say 20. Okay, but my exercise price is, let's say 15. So for a call option, we know very well if your asset price is less than, more than the exercise price, that's good for you. Your option is in the money. So that's why what we mean here is the 20 minus 15. This is the option value, right? So that's why we say greater of 0. So it can't be anything less. No? So that's the reason why we put it like that. Understood? Okay. So the next question is question number 9. An investor writes a put option with an exercise price of 40 when the stock price is 42. The option premium is $1. At expiration, the stock price is 37. The investor will realize a loss of 2, a loss of 3, or a profit of 1. That's the correct answer. A, B, or C. What is the correct answer? Okay, so this is very straightforward. So the question says you have a put option with an exercise price of 40 and the stock price is 42. Option brings 1 at expiration, stock price is 37. So if it's 37, then that means the put option is in the money, no? So you have 40. And if it is 37, you are basically 3 is what you're realizing. But then what they say is that you are paying a premium of 1. Okay. But the problem is, what? Stock price. Yes, correct. So basically what happens is the investor will realize, the question is saying the investor will realize a loss of 2, a loss of 3, or a profit of 1. Okay, look at it like this. Investor writes a put option with exercise price of 40 and the stock price is 42. Option premium is 1. Okay. At expiration, the stock price is 37. Okay, so that's what we say. Now, stock price became 37 means definitely we are going to sell at that price. Okay, so for sure we are going to sell at 40, right? Because obviously if you have put option to exercise at 40, you'll want to sell at that price, right? So then the premium is 1. But the question is asking, the investor will realize. Okay. And remember, it's writing a put option. Now, that's the trick in that question. Now, who writes a put option? This will be a seller. Now, they didn't say the person buys a put option, it's not the buyer. So, in the writer's perspective, to be honest, what happens is then you have to look at now for him, he has a loss of 3 already. Why? Because now the other party who he sold to will definitely use the option. So that's going to be basically minus 40 plus 37. So we are looking at minus 3. You get what I'm trying to say? Because now you're the writer perspective, not if you're the buyer, you would have got a profit of 3. It's a loss of 3. But since you got a premium of 1, when you add that premium of 1, it makes it loss of 2. So A is the correct answer. Is that clear? Right. So I think that's the confusion because I'm sure you guys might not have realized the fact that it is a right. So be careful. This is like a good lesson for you all in the exam. When you get questions like this, make sure that you're looking at the correct one. It's always just don't assume it should be for the buyer. They can also test it for the writer. Okay, great. So guys, we can stop at that and we'll continue next week. So next week, as soon as we start the class, we will quickly, check the remaining answers also. And then we'll move on to the new chapter. So I'll be uploading the new chapters on to my alpha. I'll give it to Raj. I think he should put it up on my alpha before next week. So then we can discuss those. Okay, any questions, guys, from what we discussed now? Including what we practice now and anything that from what we learned, anything that you want to clarify? Any questions? Otherwise, if all good, can I get a thumbs up or an okay? All good. Perfect. And very good, guys. From what I see, like you guys are, picking up quite well. So let's keep the pace up. And we have basically, totally, we have 3 classes for derivatives. So the 3 classes, I'll be completing all the chapters and I'll make sure that I do questions whenever we finish chapters so that you guys can have some questions in hand. Or of course, when you come to revision, I'll be doing like even more questions that time. Great. Thank you so much. Then I'll see you guys next week. Take care, guys. Next week, we'll discuss more questions.